Hello, hello, hello. Is anybody there?
Yes, couldn't hear you.
I was just giving you guys an
Good
opportunity.
afternoon.
Good afternoon. Good afternoon. Just giving you an opportunity to get in, sign up, stretch, have coffee. I hope you had a great week so far. Is that a yes or a no?
Yeah, yes, we have life. I'm hungry.
Yeah, we had a good week. I got you on the hungry.
Today is baby Friday, so it gets better.
What do you call it? Baby Friday?
Baby Friday.
Oh, okay.
Off for Friday.
Okay. So somebody's hungry in the group.
I'm always hungry.
Oh, Rosalie's
Yeah.
uh Rosalie, that reminds me of my youngest son. He's about 20, he's almost 25 now, and he's always hungry. And I'm like, son, you're always hungry. You've always been hungry since you were 5. And what's going on?
They don't even say I have tapeworm. They say I have termites.
I must admit, I haven't heard that one before.
I never get that one. I don't.
Call a healthy appetite, for sure, for sure.
Yes.
So remember, if somewhere in the middle of all this crazy audit, you can't take it anymore, just like run off and get a snack from somewhere, and then you can just come right back and pick up where you left off. Not to worry. Okay?
Yep.
Crystal and agony. That we can have that. All right. Okay, so let's see who's here today for today's event. This is our second session already.
Mm-hmm.
I think it's that third, is it?
Third.
Third.
It's
Third.
third.
This is our third session already.
Correct.
Where did the time go?
3 more weeks to midterm exam.
Oh, somebody's keeping track. That's good.
I just want to go say that. I don't know. I remember all this information.
Are serious?
Well, what you do is the same thing you do for all the other crazy stuff you did in your life. You just keep reading it and rereading it and making notes of important points. That's what you do. And then after you've read it so much that you're sick of it, then you start reading and studying your notes until you're sick of it, like that. Now, those who do that the most tend to do better than those who do that the least.
Yeah, I'm a Mr. Wilkinson. I used to be in my bed waking up 2 o'clock in the morning, but order this a scientific and systematic examination of the book. So 2 o'clock in the morning, going through my head over and over and over. Can't sleep.
At least I get that part down. Wow. I remember that one. Auditing is a scientific, systematic and scientific examination of the books of accounts and vouchers.
Wow. So,
I remember it, Mr. Wilkinson. I try to remember it. Tell me if I right. Y'all coach me on. Auditing is a systematic and scientific examination of the books of accounts and books and vouchers of accounts for a business to enable the auditor to satisfy himself that the profit and loss account and the balance sheet give a true and fair view of the state of affairs of financial state of affairs of a business for the financial period or something like that. I was close, right?
very close. Go to the front of the class. I sure as hell hope I ask that question, otherwise I'll be in trouble. But yes, that is exactly how you respond to the question of what is audit. Okay. Of course, you don't need to remember everything word for word, but the more of it you can remember, the better. And those that you can't remember, just kind of break it down to simple points that you can recall, and you should be fine. I don't know.
I remember drawn up, so I gone and I Google it, so I write prepared, which is the same thing.
For what?
The audit for the definition.
Uh-huh.
To give a true and fair view, I using the word prepare because I remember drawn up.
No, that's fine.
That'll throw my mind straight off.
I'm not gonna split hairs because you use a different word. As long as the information has the key correct stuff in it, that's what I'm looking for.
As long as you know where we coming from, right?
That's the point.
Okay.
Okay? I'm not teaching an English class, even though I don't want you to like write crazy stuff, but it's not an English class and I'm not splitting hairs because somebody uses one word and it's not exactly what's in the text. No. Once you have the main context down, any of the answers, that's what I'm looking for. Okay? That's the key. All right, so we're in week number 3 already. Are you guys sure? Why was I thinking 2?
It's week number 3.
So
Right,
that,
we ain't got our thing I'm at on this week number 3. And we got all this notes to study, and we gotta go work on our case study.
well, you have 12 weeks to do the case study, so not to worry. The most important thing now is to keep preparing for your midterm exam, which is week number 6. Okay, that's the priority. Of course, the case is important, but you can, when you get that, you can start working on that week by week until you finally get it done. So don't stress too much about that yet. Right? Just focus on the midterm.
That's the big grade.
Did I take my register last week?
I think so.
I'm wondering because I'm looking at my register, but I'm only taking it for 1 week. I'm wondering how the hell did that happen? I'm sure I took my register for week number 1, which was
Last week you weren't able to put your hands on the register, but you did call off everybody's name.
Okay, thank you, Danielle. That's what the hell happened. And then I found the register in the wild somewhere among other registers. Okay, perfect. Time passes quickly. Just cannot believe we're in week number 3 already. We were just saying hello to each other. Now we're in week number 3. Okay, I'm going to call off your name. If you were here, let me just update this register, and then we'll go to today's register. When I call your names, this is for last week. Okay, so if you were here last week, please shout. And I'll verify that against where I scribbled it last week. Okay, Danielle, were you here last week? Danielle?
Yes, I was
Yes, you were. Okay, and you're here today?
present today as well.
Absolutely. Okay. Elvis Bullet. Okay, those folks are off.
Coming in week 10.
Yeah. India.
Yeah.
India, there you are. Were you here last week, India?
Yes.
Okay, great. And you're here today. Wonderful. Just making sure I have everybody accounted for. Alex Feaster. Alex? Alex was here last week. I know. She said, Alex, I'm a girl, Alex. Okay, I guess Alex will join us shortly. Here for last week. Gretchen.
Yeah, present last week.
We're here last week, yes. And you're here today. Man, can't believe it's been 3 weeks already. Unbelievable. Rosalie.
I'm here. I was here last week too.
Okay, excellent. Rosalie the Termite Monroe. You know,
Once
Rosalie,
you know.
when I'm done with this class tonight and I call my baby, I'm gonna tease him about that. I said, boy, you have termites in your stomach. That's it.
I would do that.
Yeah, he's gonna like, Dad, where'd you get that expression?
Tell him where you get it from too.
I'll tell him from his female counterpart. All right.
All right.
Shakira Murphy. No Shakira. Okay, let's see. Ebonique.
Here and was here last week.
Yes, indeed, Ebonique. You know, it's interesting, Ebonique, they named you Ebonique instead of Ebony. You ever ask your parents why?
Pardon?
You ever ask your parents why they named you Ebonique instead of Ebony?
I don't know why, and I asked also because my father's name is Ivory as well, but they said that was not the intention.
Okay. How cool is that? Okay. Karen Sands.
Hi, and yes, I was here last week.
Karen, you were here last week.
Mm-hmm.
Okay, perfect, perfect. Now we just about have all the persons we need almost. Kendrika. Okay, and Mia. All right, great. We have all the key persons here so we can move. Now, last week, um, we covered the introduction and a whole lot of interesting stuff, 21 pages of it. I know it seems like a lot, but once you start getting into it and if you stay consistent, it will not seem as much as you think. Just keep reading through it, making your notes, summarizing things that you can make simple. So when it's time to do your review, you can just go back and look at the key stuff. You don't, all right, that kind of stuff. I always encourage students. We do reading in class sometimes along with the lectures, as we'll do tonight. But I always encourage students to go back and reread because the brain is an amazing thing. The more you read stuff, it's recording it, even though you don't get the feeling that that's happening. Okay, so don't hesitate to do that. Also, I don't know if I mentioned it last time or at all. Make use of your weekends. That's the time you should do your best work because coming home after work, you'll do some studying and some stuff, some reading, but you're tired unless you get up at 2 a.m. in the morning, a little refreshed. It's going to be a stretch doing it after work. But whatever works, we're all different. Certainly on the weekend, try to use that time when you have energy, when you just get up in the morning, to do your really hardcore stuff, and you'll get a whole lot more benefit out of it. As somebody mentioned earlier, your midterm is week number 6, so please keep that in mind. So that's 3 sessions away from now, including today. So let's get it on. All right, so today we are going to be talking about, anybody knows? What's module 2? What is it called? What's the heading?
Um,
Module
I
2,
was reading.
whatever you want to call it.
Audit fundamentals, principles, types, errors, and fraud.
Yes, yes, yes. Principles, audit types, errors and frauds. Anybody remembers what an error is?
Unintentional entry in the book of account.
Man, somebody is kind of getting ready already for the mid, because those are the kinds of questions I will ask. All the questions will not be like way off and some crazy thing in the wilderness. They're going to be questions like that. Differentiate between errors and frauds. See that? And why do I do that? Because those are the key things you want to remember long after you pass your course and move
But
on.
that's the thing. I want to know, like, as I'm reading it or whatever, I want to know, like, what exactly is key and then what is, I wouldn't say superfluous, but like something that I don't need to like write down in my notes. Because sometimes I feel like I'd be getting lost trying to take in everything and I know I can't remember.
No,
But I wouldn't say I can't, but
I know that's the students' hue and cry every time. And if only lecturers could accommodate that, the life would be so much something. But usually it doesn't, you'll get some hints along the way. So you keep your ears open for hints, but we don't say, study this paragraph and not that one. Study this chapter, not, we don't really say that. Now, if a particular chapter, module, etc., is not going to be in the exam at all, then I might say, you're not responsible for module X. Do not waste time with it. And so you'll be told that specifically. But any chapter module that we actually talk about, consider yourself responsible. And you just have to kind of work around it, and figure out kind of like, okay, what's key here? And if you have a question or concern about what's key, you can raise it. Say, wait a minute, is that a key point? Like if you really get stuck on what is the key point or not, and then feeling generous that they might say, well, yeah, or not really. Okay, so there you go. I hope that helps. It stinks. I wished it could have happened decades ago when I was, but yeah. All right. So, question? Okay. So let's go into module 2 then. Principles, types, errors, and frauds. Now, we are told right at the beginning, right out of the definition of what is an audit and in the introduction, that auditing is indeed a very systematic and scientific examination. In other words, auditors don't walk in helter-skelter. Okay? The auditor plans the audit and comes in with a plan of action. Pretty much knows every step of the way that he's going to take to try and make sure that those financial statements are prepared in accordance with generally accepted accounting principle and that they're true and fair. And so that's not a haphazard activity, because at the end of the day, the auditor needs to satisfy himself or herself that the P&L account is in order and the balance sheet is properly drawn up. That's what he's looking to do at the end of the day. Now, for the purposes of this class, if I say he, I mean he and she, like in the old days. Okay? Nowadays, things have changed to say he and she for everything, madam, madam, this and Mr. that. Yeah, it's a lot more talking. All right. Does anybody in the class know why in the old days we just said he to mean male and female? Anybody knows? Anybody knows at all why we did that? No, nobody?
No, enlighten us, enlighten us.
Amazing. You youngsters have not been told so many things. What a shame. The hell happened in these schools? Anyway, the reason why in the old days, and when I say in the old days, I mean up to 20 years ago before everything changed or is changing, we refer to male and female as he because for those of us who believe in creation, when, and I hope at least one person in this class believes in creation, when God created man, see, man first, and the fact that God created man first is not really an affront to any female. God doesn't make mistakes. He knew exactly why he did it that way. But of course, you know, mankind in our infinite wisdom, we want to come up with our own thing and change whatever God has established and even say at the end of the day, if necessary, there is no God, we'll call it what we want. And they're actually doing it. But anyway, the initial thing for hundreds and thousands of years was that since God created man in his image, and then he said, man should not be alone. But he didn't create the woman. No affront, nothing wrong with her because he didn't create her from the dust. God knows everything that he's doing. That's the point. And we in our little, with our little puny brain, keep trying to second guess stuff that we can't even begin to begin. And so he didn't create her. He made her out of the womb of the man and called her woman because she was made out of him, not from the dust of the earth like Adam. And so because of that, when we refer to human to man, what we're referring to is mankind. And what constitutes mankind? The male and the female. That's what we mean. It doesn't mean anything about man is to dominate the woman. Man is to kick her in the head and tell her what to do. It meant nothing like that at all. It means mankind, and there are only two groups in mankind, the male and the female. That's why it was done that way. But now, in our infinite wisdom, we say, we're trying to change the whole thing. I saw something on TV the other day where they say that they're not going to refer to women as mothers delivering anymore. They're going to refer to her as the person that delivered. How about that? They're not going to say the mother delivered because they don't want to refer to any particular sex. They're going to say the person that delivered. How about flicking that? No more boys and girls, the it's, the children, the neutrals. No more boys and girls. No more boys' clothes and girls' clothes. No more boys' bathroom and girls' bathrooms. No more men's bathroom and women's bathroom. They're all going to be unisex eventually, they say. So you guys are going to be walking in the same bathroom with me.
Wow.
That, because there's only going to be one bathroom, and it's going to be called a unisex bathroom. And women will no longer be called women because that means you're being sexist. And men will no longer be called men. It'll be referred to as sexist. You're defining their biology. And these flicking guys in their infinite wisdom who are going to drop dead soon anyway, at any time, they don't even know when, have decided that they're going to change God's entire plan. Bunch of dudes who don't even know how they got here or when they're going to drop dead. How about that? Okay, I guess you figured I'm a little pissed off about that. All right, back to audit. But I just want you guys to know why we refer to the man as being the man and the woman together. It's all about mankind, meaning both of them. Okay. All right. So the auditor is coming in with a very structured program to check everything as far as possible to make sure everything is important. Everything important is looked at. Can he check every single transaction? Hell no. It's never the auditor's job. Some organizations try to make the auditor feel that that's not their job. They cannot check every single transaction. They'll be there all year round. And which organization can pay the hourly rate for the auditor to be there all year round? Some companies have to pay a few $1 million for them to be there for 6 weeks. So they can't check everything. It's impossible. All right. Another nice test question, right in paragraph 1. What is the difference between auditing and accounting? Do you guys see that? Right in
Yes, we
paragraph
see
1.
it.
Yeah. What is accountancy? Anyone?
It is the preparation of financial statements.
And auditing?
It is the checking of the financial statement
And
and reporting the financial position of the organization.
absolutely. What are the 2 key financial statements that the auditors are looking at when they come in?
The profit and loss and balance sheet.
Absolutely. So I thought you said you didn't know anything about this.
I don't.
Okay, that's not have somebody know a damn thing about it. But yeah, okay. And these are very key things to know not only for examination day, but also for after you finish your course and gone on. When you're sitting in some meeting somewhere, some group somewhere, some the auditors come to your firm, you in some environment, and this stuff come up, you can say certain things with confidence. Once you that's why you do courses like this. And this kind of information you always need in one form or another, no matter what job you're doing. Even if you're an open heart surgeon, when the auditors come in to inspect that bloody hospital, and you're part of that discussion because you're a senior administrative person and surgeon, you're gonna, if you know a little bit about the difference between an accounting and an audit, you already way ahead of the game. It's an important thing to know. Now, when the auditors come and start talking about things, you understand it no matter what job you do. That's the fascinating thing. You don't have to be an auditor and go off and get a CPA and all that stuff just to be able to understand some of the important concept of auditing. That's the great thing about this. And regular employees on any job with this kind of information are always ahead of the game because now they know the audits are looking for, they know what to fix, they know what to put in order, and hopefully they don't use it to cook the books and do nonsense. Remember cook the books in part 1, module 1? Window dressing. Did we talk about window dressing yet?
Yes, we did.
What did we say window dressing was?
Trying to make the statements appear to be something that is not.
Yes,
You overstating the profits or understating it,
yes. All of those are book cooking.
making it look good for whatever.
All bad. Cooking the books, changing the numbers to suit what you want it to be. Usually to try and make it look better than the actual performance. Why? Because shareholders will be happier. They'll keep the board and not fire them. If profits are shown as being higher than they really are, then the bonuses will be bigger. See, the bonuses will be bigger.
I need to get back where I get bonuses. Mr. Wilkinson, what's actually from A1? You're not associated with the FIUE.
Why?
I will say it in the recording.
Oh, so that means you have to send me a text or an email, or you have to call me.
Yes, okay.
Because maybe after I answer your question, I may have to shoot you, Gretchen.
No, you don't gotta shoot me. That's serious. That's serious.
I'm just kidding. That's what they say on TV. If I tell you, I have to kill you. Uh, I'm just kidding. But if you have an off-screen inquiry, you can make it, and I'll be happy to answer. Okay. All right. Anybody knows what the FIU is all about?
Yes, most definitely.
And what do they do?
They the persons who the MLRO report to the financial intelligence unit. That's
Okay.
where all that they are actually the intermediaries between the law enforcement, which is the police force, and any financial or supervised institution when it comes to money laundering or terrorist financing, maybe even proliferations of weapons, and you have to make a report. They're the
And
ones that you report to, and then they will report to the law enforcement.
generally speaking, yes. To put it simply, there's a whole lot more, but that's
Yeah,
kind of
that's just simply speaking, but yeah, you know, they are part of the Egmont group, and they
okay.
share cases around the world with, I guess, means and ways, not means and ways, but I guess strategies in which the terrorists or the money launderers use to launder money and stuff like that.
And the beat goes on, see? And that is still not an exhaustive list, but yes, you are definitely on the right track. And anybody who works for a financial institution should have some idea of what the FIU is all about. And every organization, financial institution should have an MLRO who is responsible for reporting all suspicious transactions that are made by their staff within the organization to the FIU for investigation, etc. And once the FIU gets that information, nothing might happen, or all hell might.
Broke loose, seeing on them compare visit.
No, not really.
But it's a lot more, but I
know.
yeah.
I know. Okay. I'm just adding a little bit more for your colleagues who might be in financial services and not know, or who might be thinking about going in financial services and need to know. Okay. All right. So, as we said in module 1, what are the 2 objectives of the audit? How are they classified?
Primary and secondary.
Primary and secondary. Now, somebody said, like, what should I study? Man, just from the way I say stuff, sometimes you should be able to tell. Like, that's like that's like an exam question glaring at you right in your face. Is it a guaranteed question? Nothing is guaranteed, but it sure as hell an interesting question potential, isn't it?
Yes, it is.
Yeah.
Hey,
Well, one thing I noticed with audit, like it wrapped right back around to the same thing, basically saying the same thing I noticed from reading.
you will notice that to some extent. Okay.
Yeah.
The reason for some of it is very specific and very different, depending on what areas we're talking about, and then others they kind of wrap a little bit to keep reminding you of the primary purpose of the audit. See, so you do not lose track of its essence. Okay, separate and apart from all the vouching and checking, reviewing, and all that stuff that auditors do in order to verify information. Okay? So what is the primary objective? We said to determine the accuracy of financial information. And the secondary objective to detect and
Errors and
Incident-
fraud. Yeah.
Incidental.
all kinds of little bits of questions are in there, like definition question and short answer questions, all wrapped up in the first two paragraphs. That's what is great. And if you do your reading, you're in class, you're listening, you're hearing, stuff will stick, along with whatever notations you're making, summaries you're making in note form, 1, 2, 3, 4, 5, whatever it is. You just do that diligently and just keep reading and reviewing. You don't have to be Einstein. A lot of it will stick. Okay? Do you want to get 100% exam? We all do. Don't worry about it. Just do, like, go at it with gusto and like that. All right. There are some advantages to having your accounts audited. The last paragraph on that first page tells you very clearly what some of the advantages are. Anybody can see what some of them are?
Yes. Early detection of errors and fraud.
Notice, not just detection, but what? Early. Why is early important? Why is the word early important?
Anything as an early is important to where you could put preventative measures in place to mitigate, I guess, against the risk of
Absolutely. Anything else? If you catch cancer early, what's likely to happen?
you start a treatment process so that it
Say,
doesn't get worse.
yeah, but if you catch it late, what happens potentially?
It's too late.
Yeah. Same thing with errors and frauds. If you catch them too late, you may never find out what happened. You may never find it. And
And
definitely
never recover.
no. So early detection is definitely an advantage. What's another one? It's right
They
there.
securing loans from banks and other financial institutions.
Well, there's something before that to support that.
Oh yeah, determining the
reliability
reliability
of
of accounts.
Yes. Okay. So why is it so important that the reliability of accounts need to be determined? Simple. Window dressing. Companies lie. Companies cook the books. People make errors. There's fraud. If these things exist in financial statements, then they're not reliable. It's just like somebody who's a constant liar. Does anybody know anyone in the class who's like lie all the time?
Oh, yeah. Can't stand the kind of people.
Yeah,
Lie
and
for no reason.
Explain the claims part, please.
I will. But we have to get this liar thing out. She's explaining the claims part. Way to go. I like that. So let's get to that claims part. I'm interested in that. But let's go back to the liar for the moment. The reason why we have a problem with the liar is because after a while, we cannot rely on anything they say.
Say
Same thing. If financial statements are always subject to fraud and errors and cooking the books and all that stuff by reputation, like in certain countries of the world, like China and Russia and all these places where they do strange bookkeeping and strange accounting, they're not reliable. You pick up the statements, you don't know if it's true or not, because some of them are not audited. The auditors are run by the government. They're running scared. They do anything the government, whatever it is, makes it unreliable. Cannot rely on them. Okay? So when in this part of the world, when an auditor comes in, it brings a relief to the organization because now when the organization presents their financial statement to their banker for that $50 million loan they need, the bank is going to say, okay, we trust PwC or Deloitte and Touche or BDO, whatever the auditing firm is, we trust them. We trust them. And since they conduct an independent audit of your firm and they're giving you a clean bill of health, then we'll give you the loan or whatever facilities they want. That's the whole point. Okay. All right. And then securing loans from banks and other financial institutions. There you go. I kind of worked it in without even thinking about it. For the person who wants to know about that securing loans, that's what a good audit will do. It'll create reliable accounts. And if your accounts are reliable and deemed to be in order, then you can go to the bank and get loans without any stress. Okay? Or any other banking facility for that matter. Okay? What are the various types of audits that are mentioned in this last paragraph on page 1?
statutory audit,
Hmm?
audit of statutory audit of accounts of private firms and private individuals, and audit of trust accounts.
Indeed. So now you say there's not only just the one audit that we're familiar with. The auditors are coming. Well, those auditors that we're familiar with are auditors of private firms, typically. But we do have audits that are done for private individuals, and we do have audits that are done for trust companies, trust accounts, and we do have what we call statutory audits, which, for example, are the kinds of audits that are carried out by the Auditor General of the Bahamas. By law, he's required to check all of the government records to make sure that they are satisfactory and reliable, that the government of the country can rely on them, and that external lenders who need to lend money to the Bahamas can be satisfied that the records coming from the government, the information is reliable. This is why the Auditor General is a statutory appointment. Once he is appointed, remember, he means mankind. Once he's appointed, then he's there for life unless he retires or dies. Very seldom the auditor is fired. I don't think it can be done because it's a statutory appointment by law. He would have to do something extraordinary, like steal or defraud or do something of that nature in order to be removed from that position. And the reason for that is so that nobody from the prime minister down to the pimp will not be able to intimidate the Auditor General of the Bahamas for obvious reasons, so that that person can carry out their job of auditing government records unimpeded. Nobody could spook them, fire them, scare them, use political pressure. In case you were wondering, okay, that's just statutory audit. And of course, any other kind of audit that's required by law is also considered to be statutory. For example, all banks, for example, in the Bahamas have to be audited by law. They don't have a choice. That's why every year you see the newspapers filled with audited financial statements for domestic and offshore banks, because that is a statutory law that has been passed to make it mandatory. Okay? No choice. If they don't do it, they'll be in violation. All right. And so who is the auditor? The auditor is most often a chartered accountant. Who's a chartered accountant? Most often a CPA or Canadian CA, CGA, or UK CA, CP. Well, UK doesn't have a CPA, they call themselves CAs, chartered accountants, okay, or ACCAs. All of these people are typically persons working in an auditing firm. But that's not the only thing that auditors need to possess. It's the CPA designation or the certified chartered designation is only one part of the requirement. But as we saw earlier, and again, this is a reminder, an auditor needs to look like they need to be Superman. Do you see that list?
Yes, that's very long.
Yeah, very long. Okay. Will I ask you to list all of them? No. If I ask you a question about that, I'll say list 2 or 3 qualities other than a professional qualification that an auditor should have. See? Simple. And then you list 3 of them. You can almost make them up. Almost. Because pretty much they are what is expected of us. Most of us who are trying to do a good job, correct? True or false?
Correct.
Not only the auditor, we just throw them out there because of the independence that the auditor requires and the reliance you put on what the auditors do. So we trust them. Okay? But most of us need to be most of those things if we're going to do whatever we do successfully, for sure. Okay? All right. Before we go any further, some keywords. We saw the first one, auditing by definition. What is a continuous audit, anyone? By the way, these are the kinds of things that can show up in definition questions, see? Because these are like little definitions and they're not hard, especially if you look at them and actually think about it. All right, so don't let all the words and stuff, don't let cause you to panic. Just kind of go through it step by step. It's nothing magical. Okay? I don't walk around with this crap in my head, not crap, you know what I mean, in my head. It's just that I've been messing with it for a while and stuff eventually stays with you. And then, you know, you practice certain things over the years because you do client work and you work for firms over, and that kind of stuff. The point is, once you commit to it, it becomes a little more easy. It becomes easier to deal with rather than if you're like, you know what, that's just too much even to read. I'm tired. Tomorrow. Okay. All right. What is the continuous audit? Anyone?
Give me another word for exhaustive, please. I could just slot that in there now from
Exhausted?
memory.
Exhausted?
Exhaustive. Put in the notes.
You mean as in tired?
No, you have it has a detail and exhaustive. Because I tell you, I work on a project right now that we're gonna exhaustive. Very exhausting.
Oh.
Detail and exhaustive examinations. What you mean by exhaustive?
And then does anyone want to make a guess before I say it?
Tiring. So I know I tired.
It has something to do with tiring.
I think it's more like you've like done
go over
everything you could have done
Yes.
Right.
almost.
Yeah.
Yeah.
That's
You
what
go over
exhausted.
it like a million times till you tired of it. There's nothing more you could find, or there's nothing more could be done.
In one instance, and another instance is yeah, you pretty much covered everything that's possible, and you feel
Right.
nothing else that can be done. That's what we mean by exhausted. Okay.
Can I ask a question, please?
Certainly.
Okay. Could you make recommendations? Okay, for example, okay, let's say somebody paid XYZ into their account, right? But yet they have, let's say they have more, for example, $100 I put on my account that the company is showing that I owe. However, I still owe the company $600. Could you make a recommendation that they take the $100 and put towards the $600 or $500, for example, to bring it down to maybe $500?
Okay, your original balance is how much?
Okay, the company owes you $100, right?
Right, credit.
Okay, right. And then you owe the company, for example, let's say $600.
Right.
Okay, could you make a recommendation to take the $100 and apply it to the outstanding balance by a person?
By all means. As a matter of fact, the average company should want to do that. It's called a contra transaction.
I
Since
mean, could the auditor actually put that in the report, the recommendation for that to happen?
if that situation exists,
Yeah,
oh,
if it's,
definitely.
oh, okay. I was just wondering.
But the auditor might not even put that in report because that is considered an immaterial matter, meaning it's not critical. What the auditor might do if they see that is make a recommendation to management right away. Hey, we have a conscious situation here. You owe six, the company owes one. You might as well offset one, credit that amount to the 600, make it 500, move on. That's likely what they're going to say. And in a case like that, once you do it and they verify that it's done, then it wouldn't even get to the report. But they'll certainly make a recommendation if they see it.
Right.
Yeah.
Oh, okay.
And they should, okay, if they see such a thing. Because remember, we're using $100 in our example, that could easily be 100 million versus
Right.
500 million. See my point?
Right. But
So
I find that do auditors do a lot of calculations?
they do. It's called vouching.
Oh, so
And
that's cool.
yeah,
Because like I tell you, I in the middle of a project, I be doing some things, and Mr. Wilkinson, I just want to call you so bad.
I know. So see if we get some instant feedback.
You're right.
But
I
yeah,
wanted to give you, not to give you no precise information, but just ask some general questions.
of course, I quite
Right.
understand. I understand. Yeah, because a whole lot of things are going on, especially during an audit. And yeah, they're checking stuff. Especially the junior auditors, they come in to do the legwork. The senior auditors don't do a whole lot of vouching and checking numbers. They have their foot soldiers, junior auditors who come in and check certain information, especially if the numbers are significantly large. They will add them up to see if they add up. They'll check to see if the previous balance is the same as the current balance, and that the trial balance from the year before is the same as the beginning of the new year. All this kind of stuff, and actually add them up to see if they add up. Because sometimes companies make mistake in adding stuff up, and other times they don't make a mistake. They know it's not correct. Okay, and so the auditor is going to, from time to time, in their judgment, professional judgment, randomly add up stuff to see if they add up. Okay, then you're not going to know which ones they're going to add up. They're going to do it randomly. They're not going to tell you in advance. We want to check those numbers, right, so you could go back and check them first. They're not going to do that. Okay? At least,
Yeah, I know. I do some random stuff already.
yeah, absolutely,
Some
absolutely,
spot on random stuff.
absolutely. So you can catch people, quote unquote, off guard. All right. So what is a continuous audit? Anyone?
An exhaustive examination of the books that happens at throughout like intervals throughout the year.
Yeah, the auditors might come in twice a year, every 6 months, or the organization is really huge and a lot of crap is going on. They may come in as often as every 3 months. And then depending on whatever, some other crappy stuff, they might come in and open an office in your office and stay there for the whole year. For a couple of, who knows, a couple of years in some cases. Unusual, but it can happen. Okay, that's what we mean by continuous. We all know the difference between errors and mistakes. You're not going to go there. An interim audit, what is that?
An audit that is conducted for a specific reason at
Yeah.
any during that accounting period.
Yeah, so if management feels that there's some fraud going on, or they get a report that money laundering is going on, whatever the case might be, in addition to reporting the suspicion to the FIU, they might decide to call in auditors and have an interim audit, which is an audit during the year, not the normal annual audit, to check out what they suspect might be the problem. Okay, that would be considered an interim audit. Okay? Of course, investigation is straightforward, an examination of the account for whatever reason. We already talked about the qualified auditor, typically a chartered accountant, CPA, CGA, some such person with, of course, audit experience. If you are a
When we can become qualified auditors.
who
Us.
to become
Like you.
well, you would have to go first of all and get a bachelor's degree in accounting or similar. And then you will have to go off and write your CPA, or you can do your ACCA out of the UK. It takes a little longer, but you can do it while you work. For those of you who may not be aware of that, we have an ACCA body in the Bahamas. They should be easy to find, where you do a certain amount of courses over a 5 to 7 year period. And when you've done all of those courses, then you will qualify under the British ACCA as a chartered accountant. Other persons who do the bachelor's degree, when they're done, they might just go right ahead and write the CPA exam. It's 4 parts altogether, or one now and one later, and the other one now and the other one later. But whatever people choose to do. But that's how you get the qualification. Okay? It's a long and winding road for those of us who are interested in actually becoming qualified auditors. Now, you don't need a CPA, ACCA, and all that stuff to be an internal auditor. Okay? You really don't.
I was just gonna ask you that because that's what I want to do at my work. So I wanted to know if you need a degree in accounting in order to be an internal auditor. But based on my knowledge of it, it's more of like the external auditors deal more with the accounting, whereas the internal auditors deal somewhat with the accounting, but mostly more of like the operations of the business. So do we necessarily need a degree in accounting to be an internal auditor?
It would be preferred, but you don't have to. The problem is every now and then the internal auditor might be called upon to examine financial transactions, records, etc. And if you do not have at least an associate degree, at least, you don't necessarily have to have a bachelor's degree to do an internal audit in the account side of things, but an associate degree will give you a minimum enough accounting knowledge to be able to go and understand the operations of the accounting department. Okay, so at minimum, you want to have at least an associate degree in accounting. If you have a bachelor's, that's better. Okay, outside of that requirement, you certainly don't need an accounting degree to do the operational side of the internal audit. Unfortunately, sometimes internal auditor's job involves going into the accounts department, understanding the accounting process, and therefore you're going to be under pressure to have some accounting background. Okay, for sure.
Okay.
So even, for example, let's say you have no accounting background, you're somewhere where they say we need an internal auditor, dead bad, you're pretty bright. Maybe you could be trained to do this, and the truth is you can be. And so what do? Most of your job is operations, but you do need to have some accounting stuff. So you go to BIFS or somewhere and you do a couple of accounting classes. Okay, you do maybe 3 or 4 classes from fundamentals of accounting all the way up to intermediate accounting maybe, and get that kind of information under your belt, and that would typically oftentimes be enough, depending on where you work, for you to be able to handle the accounting side, the bookkeeping accounting side of the information. And so that would be an option for the person whose primary internal audit job is operations. Okay? But certainly you need to have some accounting, so you just go and do some classes. Exactly. Okay. Similarly, you guys who are doing this auditing class, if you're an internal auditor already or will become one, all this information is designed to do is to help you do your jobs better. If you're not going to be an internal auditor, this information is designed to help you how to be ready for audits, how to understand the language of audits, how to look for what's good, right and wrong in your organization. If you're a supervisor, how to manage people and make sure they do the job right, and to make sure that things are going the way it should go. So when the auditors come in, internal or external, everything is in order. See my point? So either way, this stuff is good for the soul. That's the whole point. And it's unfortunate that a lot of people still don't get that. They think that when they come to do an audit class, they have to be a chartered accountant. That is not true. Okay. In fact, most chartered accountants will not come to do a class like this because they think they know everything anyway. And maybe they do in their field. But for those of us who are internal auditors, who are staffers, who are supervisors and managers and board members, this kind of stuff is good to know. Clearly, you can see right off the top, because the more of this stuff you know, the more communicative you can be from the board level all the way down without ever having to be an auditor per se. Okay? Because this information covers the entire organization, any organization for that matter. If you go to church and they put you in charge of church stuff, or you're sitting down and all of a sudden you see some stuff going on contrary to audit practice, say, wait a minute, why is Pastor Tingham doing that? See, then now you have to call out the bishop, maybe, because now you have audit information. And or you might say, excuse me, in the next members meeting, excuse me, Bishop Jones, let me not say Johnson, Bishop Jones. When are we going to prepare financial statements for this church? And all of a sudden everybody goes quiet. And then the bishop will say, well, we do have financial statements. So, well, when will the membership see it? You see, all of a sudden you're bold not ask these questions because you've done some extra work. And, oh, and then you might say, do we plan to have it audited to make sure everything is okay? Then all of a sudden everybody stops talking to you and looking at you funny every week you come to church, etc. What is the point of making? This stuff is good for a whole lot of things in your life. Work and not work. And if you happen to be an auditor of any kind, all it will do is add weaponry to your repertoire. If you're not, it will add even more weaponry, because now you have a lot of information at your disposal to understand a lot of things you would not have understood before. How about that? All right, and then finally, a statutory audit, we said, is mandated by law. No choice. Okay, for sure. All right, we already had the true and fair discussion, for sure. We have already exhausted what is an error and what is fraud. But now we have a new animal. And that animal is called principal errors and clerical errors. So now we don't only have errors and frauds, now we have a new kid on the block. All right, and so what I'm going to do now is to shut up for a moment and call on, let's see, from the top. Danelle, you're at the top. Are you there?
Yes.
Okay, great. And she said, doggone, he called me. All right, Danelle, Why don't you pick it up from principal errors and clerical errors? Let's see what's going on.
Principal errors and clerical errors. Principal errors, these errors arise generally when principles of accounting are not observed when recording a transaction. For instance, a capital expenditure is recorded as a revenue expenditure, or vice versa. Such errors are difficult to detect in the trial balance. Errors occur because of ignorance of accounting principles. The following examples are examples.
Take a pen day now. Notice that little thing she said already will give you some idea of why it's important to have a little accounting knowledge. Because with a little accounting knowledge, when you hear expressions like principles of accountancy are not observed when recording a transaction, if you have a little bit of accounting behind you, that will make sense to you. If you don't have any, that will not make sense to you, especially if you're an internal auditor or even a staff member or a board member who needs to understand what that means. Okay? So for example, the example they gave us, a capital expenditure is when a company spends money for long-term assets such as equipment. Revenue expenditures when money is spent for maintenance purposes. So they have two very different purposes, but you have to understand the accounting differences in order to record the transactions correctly, which means that if you don't understand from an accounting perspective the difference between those two and how they function, then you will not understand what we mean by an error in principle, because these two transactions have been recorded incorrectly. Okay? And furthermore, without a little bit of accounting information, you will understand the expression that these errors are difficult to detect in the trial balance because, again, they could be in the wrong category but have the same amounts that are correct. So the numbers are right, but the categories are wrong. And so when it gets to the financial statements, they will be misstated. And again, how do you understand all that crap? Well, not crap, you know what I mean? Because you have a little bit of accounting background. So it goes back to the question that somebody raised earlier, and that's what makes it a good question. And suddenly we see why, in this particular case, where we are required to detect what we call an error in principle. Okay. All right. So I just kind of gave you a little background on that. So if you ever hear that coming up again, you won't be like, what the hell? I saw that somewhere. I don't remember. All right. Keep going, Danielle.
The following are examples of principal errors. Wages paid for installation of plant and machinery are recorded as wages paid to workers. Revenue receipt is recorded as a capital receipt. Incorrect provisions for doubtful debt. Incorrect provisions for discounts and debtors. Rent paid to landlord debited to the landlord account instead of the rent account. Overvaluation of or undervaluation of stock on account of ignorance.
All right. So again, these are some examples of errors in principle. If there's anybody in here who's had any accounting background whatsoever, and in some cases, not just accounting background, just common sense might help you, but not always. Some of these things you have to know specifically what they are. Okay. So for example, wages paid for the installation of the plant is recorded as wages paid to workers, right? So what should happen? These wages should actually be paid to the plant wages account, not to other employees. So that's an error in principle. Okay? Revenue receipts recorded as capital, that's an error in principle. The wrong accounts are going to be debited or credited. Incorrect provision for doubtful accounts. In other words, if you have $10 million in loans and you estimate that 5% will be doubtful, and really it should have been 3% based on the history of that company, then you will have a completely different scenario in terms of the doubtful debts. And anybody ever heard the term doubtful debts? No?
No, what is that?
Doubtful debts are those loans that are outstanding that banks and other lenders feel that they are not likely to collect for one reason or another. Okay, that's what doubtful debts are. They might, but they have a feeling and reason to believe, based on how the account was being paid during the year, for example, that perhaps the account is going downhill and a certain percentage of them will not ever be collected by the company. And eventually, those that are doubtful will eventually be what, you think?
Written off.
Absolutely. Okay. So again,
But
okay,
when I was reading the minutes, I saw something in the treasurer's report where it was saying like bad debt provision or something like that. Is that the same thing?
it is absolutely the same thing. In fact, sometimes the expression is bad and doubtful debts, the same. Now you know what they are. They are the amounts that are owing to an institution that they believe they may not collect for whatever reason. Okay? All right. So all of a sudden, you're not in an accounting class, but you're getting accounting tips. All of a sudden, you're connecting it to something you read. This is the whole point I'm making to you. Nothing you learn in this class will be a waste of time unless you are a waste of time. But certainly, the information that you gather, lots of it will always be relevant, no matter where you go. Question: what is the oldest profession in the world? They say.
Enlighten us.
If you're over 18, you can say it.
What?
If you're over 18, you can say it.
Selling?
Say it again.
I say selling.
Oh, yeah. I like that. I like that. That's actually the Bahamian expression. I haven't heard that in a while, but yes, that's what it is. That's what we say. In the Bahamas, we call it selling. In other parts of the world, they call it prostitution. All right. Prostitution is known to be the oldest profession in the world, they say. Okay. Now, in terms of doubtful and bad debts, do you think the typical prostitute will have any doubtful debts in her accounting records if she keeps them?
No,
Why not?
because you gotta pay before you get.
Absolutely. It's very simple. She will have no bad debts because you have to pay before you play. Yes. But those financial institutions, for example, they don't have that luxury and lenders. They lend in good faith on the promise that the borrower will pay. Some borrowers pay, some don't, for whatever reason. And those that don't end up as bad and doubtful debts. And then eventually, if the organization cannot get the delinquency department to get them to pay all of it, some or all of it ends up being written off. Okay? Auditors look at these things to see if the numbers make sense, to see if the provision or the amount allocated for bad debt. See, here's why. Some companies could give a bunch of bad debts and try to hide it by putting them in doubtful, eventually writing it off and nobody will be the wiser. Do you follow?
Yes.
Does that make sense, folks? Some companies could give a bunch of bad loans and then hide the bad loans under doubtful debts, meaning we might get it, and then eventually write it off, knowing that there's no chance they would ever get it. Kind of like the $500 million that was transferred in bad debts from Bank of the Bahamas a couple of years ago. $500 million in bad loans were transferred out of the bank so that the bank's financial records could be more acceptable. So that those bad debts those bad loans do not have to show up on the Bank of the Bahamas' balance sheet. This is public knowledge, not a secret. Okay? I don't know who the hell gives $500 million in bad debts, but For the most part, that's what happened. It's a very sad situation. I don't know who the hell were their auditors year over year checking that stuff. See my point? See that? Who audited those records year over year while they were building up from zero to $500 million in unpaid debt to the bank?
Deloitte.
Sorry?
Deloitte.
Okay. Yes, Deloitte. My. All right, folks. And so I presented to you as information because you are students. And when you come into these courses, you're supposed to get a little bit more than just academia. Notice all this other stuff is not in your textbook. The textbook has the romantic, what is required, what ought to be stuff. But in the real world, there's some real things going on. Like, how come there wasn't a red flag long before those debts got to $500 million? Okie dokie. So these again are some examples of principal errors. Okay. So if I said to you, give me 2 or 3 examples of a principal error from an auditing or accounting perspective, then you should pick 3 of these. See that? You can almost think of 3 without thinking already. That's why I say to you, don't let the words on the paper scare you. Just keep going and going. Okay? And eventually you'll be fine. Okay. All right. Keep going, Danielle.
Clerical errors. These errors arise because of negligence by the accounting staff. They are called technical errors. Clerical errors may be further divided into errors of omission, errors of commission, duplicating errors, and compensating errors.
More exam questions. See that? Let me ask you guys, what could be an examination question for that? Anyone? Test yourself. Come up with an
Give
examination question for
examples
that.
of clerical errors.
Yes. See that? And you can almost remember them already because we're here looking at it, reading it, stuff will stick. That's why I keep saying, don't let the words on the paper scare you. Just keep going. Errors of omission, errors of commission. Man, soon it'll be second nature, even though initially it may have been a little spooky. Like, what the hell? And all those bloody errors, who can remember them? All of a sudden, when you really look at them, they're not scary anymore once you really look at them and start paying attention. Okay. All right, then I'll keep going.
Reasons and circumstances for errors and fraud. 1. Ignorance on the part of employees of accounting developments, generally accepted accounting principles, appropriate account classification of the necessary reconciling subsidiary ledgers with controlling accounts, and of good accounting practices in general.
In other words, if your staff are not properly trained, you're gonna have a bunch of errors in those accounting records, and the auditors are gonna have a nightmare, and that is gonna affect the audit outcome. So, like everything else, you have an accounting staff, the best thing you can do is make sure that they're properly trained to do their jobs. See? That's one way to mitigate against these kind of errors and save the auditor a bunch of stress. Because the more errors the auditors find, then they will have to make recommendations for all of those errors to be corrected, reversed, turned around, whatever the errors are, they all have to be corrected. Take out the old errors, put in the correct stuff. That can be a nightmare. And then oftentimes, if the accounting department is not qualified to do it, the auditors people have to do it. And they're going to charge you for all that stuff. So you have to pay extra. All right. Okay, keep going. Number 2.
Carelessness on the part of those doing the accounting work. A desire to conceal the effect of defalcations of or shortage of one kind or another.
What is that called?
Fraud.
Fraud. And what did we say fraud was?
Intentional.
Absolutely. Keep going.
A tendency of the management to permit prejudice or bias to influence the interpretation of transactions or events or their presentation in the financial statement.
Fraud
And
again.
pardon me?
Fraud again. But this
Yeah.
time it's perpetrated by management. In other
Management,
words, instead of following the generally accepted accounting principle, management decides that they'll interpret the transactions or events how they want it to be and force the accounting people to present in the financial statements the information incorrectly according to their interpretation. How about that? And when the accounting people say, but this doesn't conform to generally accepted accounting principle, then that manager or board member, whomever might say, who is your boss? GAAP or me? What does GAAP mean, anybody?
generally accepted accounting principles.
Absolutely. Okay, that's what number 4 is all about. That's some serious crap. That's why it falls under fraud. And remember what we said about fraud. It's intentional. And some of the worst frauds in the world are the ones perpetrated by board members and senior management. Not, Tingham them at the top, as in number 4.
Yeah, and the chairman there.
At the top, beginning with the chairman them, and all the way to senior management. Those are banking facilities and companies around the world that suffer the greatest loss. It doesn't come from the people in the middle or the bottom. It comes from the people at the top engaging in these fraudulent activities. Notice I didn't say engaging in errors, because errors are unintentional. It happens because of fraud. All right, keep going, Danielle. You started it.
An ever-present desire to hold taxes on income to a minimum. That's fraud.
What does anybody know why that's fraud? Trying to keep taxes to minimum. Why is that fraud?
Oh, that could go deep because you might be trying to evade taxes and all kind of stuff.
That's what it means, trying to keep it to minimum so you do not pay the government the full amount.
Yeah, that's why they say compliance and audit go on and on.
Of course. The VAT department is checking companies as we speak to make sure that they're paying the correct amount of VAT, because many of them are not. They're trying to evade paying the correct amount of VAT. They're trying to set the records in a way that they pay the minimum amount, not the correct amount. That's fraud, by the way. All right, keep going there now.
The intentional effort by persons in positions of authority to 1, enhance the picture depicted by the statements, 2, depress the picture depicted by the statements, and 3, cover up errors and fraud.
Kiss my foot. And notice those 3 deep and dangerous things. See? Enhance the picture, depress the picture, and cover up not only frauds, but errors as well, even the unintentional stuff. And who were these done by? Persons, what?
In the head.
In positions of authority. And notice, not only persons in positions of authority, but they also make an intentional effort to do it, meaning that it's no mistake. It's done on purpose. While the rest of us are slaving down the line. And they're requiring of you, tell us, don't take any money at the till for no lunch. Otherwise, we refer to that as theft and fire you for that $10. Truth be told, it is theft. Whether it should be fired is another story. But the real problems are not at the teller level or the middle management level. The real horror show is at the top of most organizations. Ironically, that's some deep and dangerous stuff. And look where you find it, in an audit class. The other place you might find it is in one of my other classes called corporate governance. because this stuff in number 6 is what we call poor corporate governance. But senior management intentionally perpetrate these things.
Ah, you teach that class?
I do.
Corporate governance?
Yes.
You're not an analyst, say. I'm trying to figure if your name sounds familiar to me for a reason.
I'm not an analyst. But I've done all kinds of crazy things in my lifetime, if that helps. Compliance is only one of them. Accounting is only one of them.
Oh, you're too smart. Okay.
Well,
Tell us how you do it, sir, in a short space of time. What do we need to do besides? Because I just walk with this book wherever I go now.
you mean this information?
I have to because every little opportunity I get to look at my book, I have to take advantage of it. There's a lot of notes to cram down in a short period of time.
Yeah, that's what I used to do back in the day as well. Or every lunch hour, nobody could find me. Every break I got, nobody could find me. When everybody was sleeping at night, I was up. That's kind of how you have to do it until your semester is done.
Yeah, I don't do the 2 o'clock in the morning like someone said earlier, but I find myself if I get up like 5 or 6 o'clock in the morning, I'll pick up the book and go over stuff for 1 hour or
Oh yeah,
so.
whatever works. Remember, everybody's different. And so you have to find what works for you and then commit to it to your very maximum that you can. That's kind of how it works. Okay? And the key thing is to be consistent and persistent until you're done. That's the key. The thing you don't want to do is to not be persistent and not be consistent and not be reviewing regularly and not be studying regularly and not be making notes regularly and just kind of like hitting it now and then. That's not going to work. Now and then will drown you, just like any other now and then. If you're dating somebody now and then, that's probably not going to work. Same principle. If you want it to work, you have to do what? Anyone? You want it to work?
You gotta be consistent.
Absolutely. You can't call them every 5 weeks and say, hi, just checking in. By that time, they have 25 other girlfriends or boyfriends dating or whatever. Because they know you're only going to call every 5 weeks. That means you're not serious, perhaps. So academia is like that. So you're on the right track. If you're walking around with it, that's the key. So that every moment you get to do a little reading, a little review, that's the key. And there are definitely benefits in that. Okay? All right, Danielle, types of errors now.
Types of errors. Errors of commission includes posting errors, casting errors, and totaling errors. For example, sale to A has been recorded in B's account. It is a posting error, or it is recorded as A's account, but the amount is wrongly recorded. Similarly, the balance of BSD 510 is carried forward as BSD 501, a casting error. Certain errors will not affect the trial balance. For example, posting in a wrong account will not affect the trial balance, but if there is a totaling error or a casting error, then the trial balance will not agree.
Okay, so you see, when we say errors of commission, commission comes from the word commit. Like we have committed fraud, we've committed adultery, we've committed sin. All right, it's something we've done. So all errors of commission relates to something we've done incorrectly, but unintentionally, because we know errors are what? Unintentional. Okay. So all these errors we committed, but they were, for one reason or another, unintentional. And these are just some of the examples of the kinds of errors that you can see in any particular environment. Okay. Most of these in this case are accounting related errors, but a lot of the fraud in the world are accounting related. That's why the auditors have to come in to check that stuff. A lot of the frauds we find going on in companies are not necessarily operational, mostly financial and accounting. That's where the real big problems are oftentimes. Not that there aren't any operational issues that problems. There are. Okay? But certainly from the auditor's perspective, they are always keen about these errors of commission. Okay, okay, keep going. Errors of omission.
Errors of omission. While recording transactions, the accounting clerk may omit a transaction, either fully or partially. If a transaction is fully omitted, then it will be difficult to trace as both the debit and the credit are missing. The trial balance will balance despite these errors. However, if a transaction is partly omitted, then only one aspect of the transaction is recorded. In this case, it is easier to locate such an error.
Thank you so much, Danielle, for all that stuff, for getting us started. All right, so the error of omission is kind of the opposite, where you've left out something completely in the records, or you left it out in part. If you left it out completely, as they said, the trial balance will still balance because there's no record of either the debit or the credit. Well, some of you may have done accounting or heard about it somewhere. The fundamental rule in accounting is that for every debit, there must be a. Anybody know?
Credit.
Yeah,
Credit.
for every debit, there must be a credit.
Credit, check and balance.
Absolutely, and vice versa. For every credit, there must be a debit. Okay, so if I sell a dress for $1,300, God forbid, and I am paid in cash, the cash that I receive should be debited cash for $1,500. The sale should be credited to the sales account for $1,300. Until it is done exactly like that, that transaction in accounting is not complete. Okay, folks, for every debit, there must be a corresponding credit of the same amount. The only thing that would be different are the accounts to which they are debited and credited to. But the amounts must be the same, and there must always be one debit and always be one credit for every single transaction, whether it's 1 cent or a gazillion dollars, whatever that is, a gazillion dollars. Okay. All right. So this little box that I have here, really it wasn't designed to frustrate you in any way. It's really just to give you a little bit of insight on some accounting principles. Not that you're here to be accountants, it's just information. So as you move around your life and your office and your church and your home and your job as an internal auditor and whatever you're doing, these kinds of things tend to come up from time to time in discussions and reading, whatever the case might be. And if you've been introduced to it, like tonight, you'll be like, oh, that's what the hell that is. Okay. So what are we looking at in these boxes? We're looking at some information relating to accounting principles, and we're looking at some information relating to compensation. And very soon you'll find out the difference. Okay? For example, what is an accounting principle? Anyone?
A transaction that is recorded in the books. Oh no, wait, is that it?
Yep, that's it.
That is recorded in the books in an incorrect. Well, is it supposed to say that incorrect manner?
I know, it's interesting. Why did that get your attention?
Because it said a principle. I don't know. It just seemed off, odd.
I know, because every time you hear recorded, we think the word that follows should be correct, right?
Right.
That's not true though. Even though I get your point, 110%. When people are committing fraud, they're always recording stuff incorrectly in the book. See my point? So what they're referring to here is an error in principle, where the information is being recorded what? Incorrectly in the book.
Okay.
Okay? On purpose, remember? On purpose. On the other hand, what is a compensating error? The meaning.
An error which is counterbalanced by another error so that it is not detected by the trial balance.
See? So one compensates for the other one. So you have an error, and then it's offset by another error, so it balances out. It becomes zero, and therefore you can't pick it up. Why do I throw these things in there? Just to show you the kinds of things that auditors are checking. Okay.
So what is the difference between that and this thing which says if a transaction is fully omitted, it will be difficult to trace both the debit and credit. The debit and credit are missing. The trial balance will still balance despite these errors. Is is that the same thing? Because with the error and omission, it's like the debit and the credit are missing. So do they both compensate for each other so they go undetected in the trial balance?
One might refer to that as compensating, but that's not exactly the same as the example given.
It don't exist.
Okay.
That's what I mean.
But some persons might refer to it as compensating by virtue of the fact that it never happened because you failed to put it in the very beginning from the beginning. In the box, in the compensation side, something happened. Okay, the error was made, and then it was counterbalanced by another error that was made of the same amount, pretty much more than likely, and therefore one offsets the other, and it does not show up on the trial balance as an error. That is a bunch of activity that happened, as opposed to an error of omission where nothing happened. You never did anything at all. So you took the customer's money and you didn't post the transaction. You didn't deposit the money to the bank. You didn't do anything. You just took it and did nothing.
You put it in your pocket.
You put it in your pocket.
Well, gee, that sounds like fraud than an error.
Well,
it's cheating in a way.
Yeah, thieving.
Well, you know, I even say thieving and not stealing, but
Yeah,
that's what I mean in Bahamianese.
We know the Bahamianese for stealing. Okay. So yeah, that error of omission means you never did anything at all. The compensating side of it, some things happen and one offset the other, and then the trial balance doesn't balance. So there's activity there. Okay. What about types? Different types of principles, errors which do not what?
Affect profit.
Errors which do not affect profit. For example,
manufacturing wages posted to the trade expenses account or wrong classification of assets or liabilities.
Yeah, so you can see, again, these are all accounting principle errors. And without a little accounting background, some of this stuff will be like mumbo jumbo. So you can probably figure at this point, since somebody raised it earlier, I'm not gonna get you bogged down in the understanding of the types of principles and compensation. I might say describe the difference between principle and compensation in terms of its meaning, like the first one we did, but I wouldn't bog you down and say to try to understand errors which should not affect profit in terms of manufacturing. No, I wouldn't do that. Okay, because most of you guys can kind of have that kind of background. I just kind of threw this in here so that you can see how much of the issues among all the other thousands of things that auditors are interested and responsible for looking into. Okay, so in terms of the different types of principal errors, we have errors that do not affect profit. We have errors which do affect profit. And so auditors are always looking to see if these things are being done properly, whether from a principal perspective or from a compensating side. Okay? For example, if you look at the compensating side, it says it may or may not affect profit. If both original and compensating errors arise in the revenue accounts, profit will not be affected. One will offset the other again. But if one arises in the revenue account and the other in an asset or liability account, the trial balance will agree, but profit will be incorrectly stated. Clearly, a bunch of accounting mumbo jumbo. Okay, so I'm not going to hold you liable for, say, an explanation on the types of errors in principle and compensation. I'll hold you responsible for the meaning, because you can actually just understand that. And then I'll hold you responsible for the effect on the trial balance, because the explanation is simple. On the principle, these errors will not affect the trial balance. On the compensation, these errors will not affect the trial balance. See? So, hint, hint, hint. When you're looking at this box, oh yeah, I've explained them to you a little bit, but I already said I might ask you to explain the differences in meaning and maybe the differences of the effect on the trial balance. But certainly, I'm not going to press you to come up with some explanation for the different types.
So what about the effect on the profit?
What about it? I like that. She's like, you didn't say anything about that. Well, in terms of the principal error, what effect could that have on profit? Well, we are told that that error involves income and expenditure accounts, something we saw a little bit earlier. For example, the incorrect distinction between capital and revenue. Okay. Do you need to be an accountant to understand that? No, because all you need to know in terms of the effect on profit is that there is this incorrect distinction between capital and revenue, or they're not correctly distinguished. That's all that is. In case of compensating errors, we are told that these errors involve income and they affect profit. If an error affects an asset and liability only, profits are not affected. Okay, more accounting mumbo jumbo. Okay, so just for the record, so you guys don't get bogged down in this accounting side, that's not the intention. The intention here was just to introduce you to some additional accounting issues that auditors are checking when they come into your firm where you work. Okay, whether you're aware of it or not. The key things for you guys to keep in mind is to know the difference in meaning between principal and compensating errors, and also to understand the effect on the trial balance. That is all I will hold you responsible for in terms of tests. Okay? The other stuff, all you need to know there is that these errors, in fact, affect the financial statements. Okay, and let your auditors worry about the rest. All right. Good point. She says, what about the effect on profit? Are we going to be responsible for that mumbo jumbo? No, you're not. Okay, thank you very much, Danielle. Let's see now. Who's my next? India, did you read last week?
No, but I read week before last.
Are you happy? Okay, wait. In other words, come back to me. Point well taken. All right, India. I'll keep moving. I'll come back to you later. Is Alexandra in the room yet?
No, I don't see her.
Yeah, Alexandra down at that central banking. Okay. Gretchen, did you read last week?
I know I didn't.
Okay, Gretchen. Then why
I
don't you?
can't read like Indian Save the week before though.
Well, if you say that, now you're gonna force me into my next option.
I can read, that's fine.
You don't have any problem reading?
No, sir.
Okay, Gretchen, let it rip then. Types of fraud.
Okay. Types of fraud. Frauds. Fraud refers to intentional misrepresentation of information by one or more individuals in management or by third parties. It is willful misrepresentation to deliberately conceal a material fact with a view to deceive, cheat, or mislead another person or party. There are three key types of frauds. The first one is manipulation of accounts. Second one is misappropriation of cash. And then the third one is misappropriation of goods.
Nice test question. Keep going.
Manipulation of accounts. Manipulation of accounts is said to be committed when a person makes a false entry in the books of accounts, known it to be wrong. They alter or destroys a true entry in the business records or prevents the making of a true entry in the business records. Normally, it is done by people in top management.
Excuse me, where?
Top management.
Kiss my foot. Really? Keep going.
It is often done to overstate or understate the profits and the financial condition of the business to satisfy specific objectives. Manipulation may be done in any of the following ways. Number one, non-provision of depreciation on fixed assets. Number two, overvaluation or undervaluation of assets. Number three, recording revenue expenditure as capital expenditure. Number four, showing expenses of the next year in the current year's profit and loss account. Number five, not recording current year's accrued expenses. A common form of manipulation of accounts is known as window dressing. Window dressing in accounting is an effort made by the management to improve the appearance of a company's financial statements before it is officially released. It is a manipulation of financial statements to show more favorable results of the businesses. Misappropriation of cash. Misappropriation of cash is also called embezzlement. It means fraudulent appropriation of cash belonging to another person by one who has been entrusted to it. Misappropriation may take place in the following ways. Number one, not recording a full cash sales and pocketing a part of the proceeds. Number two, teaming and lading. Number three, misappropriating money received from the sale of goods. Number four, making fictitious entries in customers' accounts for bad debts and discounts. Number five, misappropriation of the amount received from the sale of defective goods by not recording such sale. Number six, recording fictitious cash purchase. Number seven, recording payments to fictitious creditors. Number eight, not recording discounts received from creditors. Number nine, recording payments to dummy or ghost workers and pocketing the money.
Take a pen for a minute, Gretchen. So you see, there's a long list of how cash can be misappropriated. We've seen that accounts are normally misappropriated by senior management, top management people. They're the ones that can go to the financial controller, people in the accounting department, and make them demand, insist, threaten, whatever they do. Collude, how's that? Bribe, whatever it is, to get these people to make changes to the financial statements, to the records. Okay, that's manipulation of accounts. Sad that it comes from the top, and the reason why it comes from the top mostly is because only the top can get those people to do that crap. Because normally people are trying to do the right thing, and this kind of stuff that top management would require can only come from somebody who has the authority to either intimidate and or direct staffers to do some of these things, to window dress. See? Cash, on the other hand, anybody from the board chairman to the janitor can manipulate cash depending on how we manage cash. Okay. And notice we have a whole list of ways that people can get their hands on company money. Okay. Money comes in, they don't record the full sale, or they don't record it at all. Error of commission or omission, depending on which one they choose, and keep the rest. Or keep all of it. Okay. You sell goods, you misappropriate the money. Why? Because you don't record the transaction to keep the money. You don't deposit in the bank, you keep the money. Okay? Putting in fictitious entries in the bad debt accounts and discounts showing incorrect amounts. It's called manipulating the accounts. Again, window dressing to make things look better or worse than they really are, for whatever reason. Misappropriation of the from the sale of defective goods by not recording the sale, very common problem. Very common problem. Recording fictitious cash purchases. So it never really happened. How about that? So if it never happened, what happened to the cash? Anyone? If there's no sale, sorry, no purchase.
No money, go in your pocket.
Yeah, in your pocket. Everything is in your pocket. You can almost make a song called "In Your Pocket," correct? How about that? And so we can almost use the lyrics from Misappropriation of Cash to make a song. Has anybody seen that yet? I'm sure some Bahamian can come up with that, recording fictitious cash purchase in your pocket. And then they just use all that stuff and say in your pocket. All right. Recording payments to fictitious creditors. See? Who is a creditor? Anybody?
Well, okay, question. I just gonna ask about that. A creditor,
Is someone who owns the business.
Somebody who what?
Well, someone with a business. Oh gosh, you'd explain this in the reverse in the first class. No, it's a creditor is a credit like a liability.
Yeah, but who's the creditor?
Is
So
it,
the person who I owe.
Yes,
no, the person who,
the person or business whom you owe.
mean like for service, right? I was like trying to, well, no,
Not service.
no.
No, when somebody gives you credit, what are they doing?
they consider the creditor, right?
Yeah, what are they doing when they give you credit?
So wouldn't that be someone who
As
you,
a supplier
Yeah.
A supplier on what terms?
on credit,
Meaning?
right? I get, you give me goods today and I pay you, you give me goods today the first of the month and I have to pay you by the 30th of the month or 3 months later, something like that.
What is that called in Bahamianese?
Trust.
I
A
owe
loan.
you,
A
loan.
loan. A
I owe you.
creditor is an individual or institution that gives a loan. Okay? So if somebody is not recording discounts are being received from creditors, then it means that where's the discount going?
In your pocket.
Everything is in your pocket. Okay, absolutely. Recording number 9, recording payments to dummy or ghost workers. In other words, those workers don't exist, but they're on the payroll, and you make the payment to them as if they're still there. And then you keep the check and deposit it to your account. And if you're the person who manages those checks, and when they come in from the bank, you file them away. Nobody's going to know that you deposited to your account, got money, and just file it away. But the auditors should be checking for stuff like that, theoretically. That's why they're all here. Because when those auditors come in with their structured program, while they can't guarantee anything in terms of errors and frauds, that doesn't mean that they're not looking to fall upon them.
Mr. Wilkinson, can you explain the difference between how they reverse the words debit and credit in banking versus accounting again, please? You did it in the first class, but I still kind of like didn't. I understood it back then, but I forgot.
Okay, here's what happens. In accounting, everything that a company owns is called an asset. Okay, and assets are always debited. So if a company owns cash, we debit cash. Company owns equipment, we debit equipment. Company owns land, we debit land. Okay, that's the rule. Everything a company owes is called a credit. So if a company owes the bank for a bank loan, we credit, that's a credit. If the company owes another company for goods that they purchase, it's called accounts payable. They have to pay that company, that's credit, because that's what they owe. That's rule number 2. The third rule is the equity in the company. In other words, your investment in the company is always a credit. That's rule number 3. Now, that's the accounting side. Of course, those rules never change, so you have to learn them. And once you learn them, you're fine because they never change. Never. Now, here's the problem with the banking side. When we receive money into the company, it is received as an asset of the company. True or false? In other words, when the company sells something and gets money, do they own it?
If they sell something and they get money for it,
If you
Yeah, the
sell,
company on it.
if you sell 10 dresses for $50,000, do you own $50,000?
yes.
Yeah.
Yeah, so we debit which account?
See,
The 50,000, the cash.
Yeah, we debit cash for 50,000, right?
right, and you
Yeah.
credit the sales account.
Right,
And,
now,
and the sales account is actually being held in the bank, right?
no,
No?
no. The sales account is being held in the company's general ledger. You debit cash.
Yeah, I mean, yeah, but
Watch and see how it happens. We debit cash for 50,000 because cash is an asset, correct?
correct.
Then
Yes.
you take your cash and you write up a deposit slip, right?
Yeah.
And you take it where?
To the bank.
And when you get to the bank, what do you tell them? I want to.
Credit my account.
Now, why is it that in the office it's a debit? We know why, because it's an asset in the office, correct?
Correct.
Yes.
Bank, your account is credited. And the reason why your account is credited at the bank is because that bank account at the bank is not yours. That's the bank's account. And the bank credits that account because to the bank, that is not the bank's money, which means that your deposit to the bank is a liability to the bank because they owe that to who?
Me.
Every time you walk in for your money, they have to give it to you, correct?
Correct.
Yes.
So to the bank, it is not an asset. It is a liability. And therefore, all liabilities are what?
Credited.
Simple.
Okay.
That's why.
Thank you.
I feel that confusing.
Sorry? No, once you keep it that way, it is not confusing at all.
So basically, it is a credit because it is a credit at the bank because the bank basically owes that money to me because I could come in at any time and say I want to take that money off.
Correct.
It's a
Right.
credit too because you actually have to credit the actual your own books.
No. The bank
You
books
say a
are,
debit have to equal a credit. So it's
no. What
when
the
you put
bank
the money on a debit means a good thing for the business. And when you credit your money, when you take your money off your account, of your ledger books and you put it in the bank, you actually, if that bank can't produce that, you know what that means.
listen carefully. What you do in your company has nothing to do with what the bank does when you make a deposit into the bank. Here's how that works.
But I do accounts 1 and 2, but I had to explain it. How you explain it could make it. I know, but I know one thing. When I went into banking, I know I had to get adjust to the opposite of accounts.
It's not, see, here's the point. The bank has the same type of accounting records that you have. The bank has a balance sheet with assets and liabilities and equity, just like you.
Right?
And therefore, when you put your money into the bank, since it's not the bank's money, they cannot debit cash. You guys don't get it yet, do you?
Yes, I get it.
We get it. We know.
I get
we
it.
know.
So that means like their loans would be like debited
Yeah,
Oh,
now,
since the loan is owed to them.
now once, if they give a loan, when you make your loan payment, that money that comes into the bank is now the bank's money. So the bank
Right.
can debit that to their cash account.
So, Mr. Wilkinson, what you're basically saying is both is credits on both sides. That's what you're basically saying, right?
No,
Could you explain about incorporating the banking it to them, please? I think I understand what you're saying, right?
no, but you cannot explain it out incorporating the bank because you know why the bank side has a credit balance and the company has a debit balance. And that's the company's cash has a debit balance because the company owns the cash. The bank, when you go and deposit into the bank, it is credited to your account because the bank holds it as a credit because they owe you the money. It's a liability.
I still think that's very a very deep explanation for them who probably don't understand accounts too well.
No, not at all.
No, it wasn't because when because I did accounting, and so when I
Right,
went
that's why I
into
say
the
who
banking, they
don't, right.
because I was trying to figure out like why they telling me to unlearn everything that I learned in accounts. So now that they still have explained it to me. So this is the first time I actually understood it in all these years by
When I
him
first
explaining that.
No,
when
exactly.
I first went into banking, it was confusing to me too from
No,
coming learning accounts.
listen to me. The only reason why it was confusing is because you never got the proper explanation. And the only reason why you never got the proper explanation is because the people in the bank did not know the proper explanation. All they know is when the money comes in, credit the customer account. They did not know why. And many of them still don't know why today because they don't know that that credit to the customer account is a liability of the bank. And liabilities in accounting are always credited. That's all.
Yes,
Whether it's bank
thank you.
side
Right,
or
we know that.
customer side.
I know that, but I know when we doing accounts 1 and 2, they never talk with no bank. All they talk about is when you have a debit, you had to find a balance for them credit. It wasn't the
Oh,
bank.
no. What you're talking about is completely different. All
Right.
right. That's different from her question. Her
Okay.
question was, why was it a credit in the bank? Your question is, in accounting, whenever there's a transaction, I remember I said there must be a debit and a credit. Right? The same thing happens in the bank. When the bank has a transaction, it does the same thing. For every there's a credit, the principles don't change. That's the point. Whether it's a bank, food store, gas station, it does not matter. The accounting
Right.
principles are the same no matter what type of business it is. Okay?
Right. Right.
Okay, thank you.
Again, okay, because the bank have just credit on my account right now, right? But I can go debit that, so that money could be in my hand.
No, you're not debiting it. When you go in and say, give me my money, they're debiting it, not you. And they're debiting so they can stay on the correct
Right, when you
side.
say debit account, well, I mean a credit on my account means you have money, but then right, and then when they debit the account, they gotta. You understand that, right? You understand what I'm trying to say, Mr. Wilkinson?
What I'm saying to you is, when you go into the bank, say, I want my money, the bank is doing proper accounting principles that you are not even aware of. All you know is you got your money, but there's still rules of accounting. Okay? For example, let's say you own a company and you have to pay $5,000 for something in cash. Let's say you have to pay $5,000 to purchase a truck. What journal entry would you make?
In account,
In your records, of course.
well, that's a credit.
What's a credit?
Removing the money.
Well, how do you accounting?
Yeah, because I got going as an expense. Don't we have something?
I know, but see, this is what I mean. For every debit, there must be a credit. So
Right.
if there's a transaction for $5,000 and you're buying a truck, since you are purchasing the truck, you own it, true?
Right, so that's an asset.
And so all assets are what?
Debit.
Good. So you debit truck. And what do you credit?
Um,
Money?
Cash. because it's
Top
going
right.
to your account.
So you balance it off by adding truck and debit and cash.
No, you credit in cash.
And debit in the truck.
Now, when I
Yeah.
say debit and truck and credit in the cash, you take, okay, you add the truck under the debit side, on the left-hand side, and then you go in and cash on the right-hand side, and you removing the money that could balance it off.
Yes,
Truck and cash, right?
every
The
debit
truck is the debit, and then the cash is the credit.
and every transaction has to have a debit and a credit. Now, let's go in the bank for a minute.
Yeah, back there.
When you deposit your money into the bank, they credit your account, correct?
Yeah.
Right, but as you're saying that that's their terms,
No, they credit your account, but they
Right.
need to follow the rules of accounting, which means that in addition to that credit to your account, they need to have a debit.
right?
What account do you think they debit?
I don't, okay, customer account means general ledger,
Cash.
Cash,
cash.
cash.
They
I
debit
so,
cash.
yeah, I mean,
Cash.
And here's what happens. They put the money into the cash account as a debit, and then they credit your account, which is a liability account. What is a liability account, anyone? What does that mean?
account with high risk.
No,
Oh,
account
I know.
that you owe money for. In other words, if you have a loan at the bank, that's a liability for you, isn't it?
Yes.
Because you owe that money. Correct?
Mhm.
yes.
Yes.
Correct.
Liabilities in accounting always have a credit balance. And so when you deposit your money in the bank, that's a liability to the bank because they don't own that money, they owe that to you. Does anybody get that yet?
Yes.
Yes, I get it.
And since they owe it to you, it's a liability and the balance is a credit. That's it.
So what part you say is debited? They when
Debit
you
to
put your
cash.
cash in there, they credit your cash, and then what is debited?
They debit their cash until you come to
Their
get it.
cash. Oh, okay, I got you.
You see? Now,
They
when you
only-
come to get it, if you say, I want $5,000 on my account, then they will debit the liability account and credit cash and give you your money, just like any accounting practice.
Okay.
They'll be crediting your account, but you're the money off and debiting their account on the back side of it.
No, they're
That
gonna,
means you losing cash.
no, they're gonna credit their account because they have to give you the money.
No,
they're
I
gonna
mean the front side of it, I mean the back side of it when time to pay back
pay what back?
the loan.
Oh, that's a different story. If you're paying the loan back, that's a different transaction from when you go in the bank to get your money. See my point?
Yeah.
The
Thank you so much.
important thing is that you now understand why we say credit to the bank and why it's a liability to the bank. That's the important point. Okay?
Thank
Absolutely.
you.
And a lot of times, nobody explains that sufficiently enough to persons for them to understand. Okay? All they say is, forget about all that other stuff, credit account. Because oftentimes persons who are training you and telling you don't really know either. All they know is what somebody told them. They don't even know that that credit that the bank has is a liability account, nor do they know why it's a liability account, nor do they know what a liability account is. All they know is when the customer brings the deposit, credit the account. That's all they know. And then that's all they tell you. How about that? And so when someone says, why do you do it? Oh, that's the way my grandmother told me. Why do you do it? That's the way my grandmother said like that. All right. Until, of course, you get a little more information like tonight, and you're like, oh, that's why they credit the account. Because it's a,
Makes sense, so.
yes, indeed. All right,
Makes
keep
sense.
going. Greg.
Okay, misappropriation of goods. This refers to the fraudulent application of goods by those who handle them. It can be done by recording sales of larger quantities and misappropriating the balance, or by recording purchase of large quantities while receiving less quantity, and then receiving the balance amount privately.
Privately. People are up to all kinds of crap. All right, keep going.
Risk of fraud and error in an audit. The following events may increase the risk of fraud or error. Number one, internal control weaknesses. Weaknesses in the design of internal control systems and non-compliance with established control procedures. For example, a single person being responsible for multiple activities in the accounts department.
What's wrong with that? Anyone, what's wrong with that? Why is that a control weakness?
Because the person, they can't check and verify their own work.
Well, a single person doing it will be doing everything. So it makes it easy for them to do what?
Steal.
Simple. So it's not complicated. If one person is making the sale, the person who makes the sale writes the deposit. The person who writes the deposit deposits the money in the bank. The person who deposits the money in the bank posts it to the company account in the general ledger. Man, they can manipulate that process and any process to any extent that they wish.
Well, that'd be easy.
Okay? Which is why if you work for any organization where one person is doing everything or too many things, you have a serious, like we say in the Bahamas, flicking problem. Okay, folks? I don't care where it is. It's a major internal control weakness and no auditor wants to see it. They will eat that alive and eat any organization alive who's doing it. Because they know, even with better controls in place, people collude and still thief. True or false?
True.
Okay.
Oh, I hope that's a question on the exam.
That's a possible question for sure, because it's such a serious matter in the real world and in the audit world. Okay. All right. Number two.
Doubts about integrity or competence of management. For example, domination by one person, high rate of employee turnover, frequent change of legal counsel of auditors, and significant and prolonged understaffing of the accounts department. Sorry, I read glasses.
Okay. In other words, where any of these things are out of whack, if one person dominates everything, that means they could do all kinds of crap and nobody's going to be the wise until they're discovered, if they are. That's why a lot of times people in high and top management tend to be very like dictators. And dictators are very suspect, because most of them, not most, but many of them are oftentimes up to no good. And they use fear and intimidation and dictation to make people do their garbage. Does anybody understand what I'm saying?
Yeah.
Okay. High rate of employee turnover means that people keep coming in and out because they're up to no good, stealing, running off with stuff, not staying, being discovered and fired, and so on. Frequent change of legal counsel, meaning that, for example, you might have a lawyer coming in to work for the firm, and because management is always up to some garbage, the lawyer says, "To hell with this, you're not putting me in jeopardy, you're not listening to my wise counsel. You guys are a bunch of gangsters, I'm out of here." Frequent change of auditors. Just because the auditors wouldn't do what the credit union board wants them to do. See, credit union board, because they're a whole different group of animals than other boards. They tell the auditor you're fired because the auditor wouldn't do what they want. What they want, what some group of members who are elected to the board wants. They want what they want because they're a spoiled bunch of board members recently selected or been on the board too long. So long they want to tell the bloody auditor what to do. If the auditor doesn't do it, then fire them or seek to intimidate them. All kinds of ways for frauds and errors to occur. And these few that I picked out, you do well to keep them in mind, not only to get through your examination questions, but for your everyday bloody life, no matter what work you do. These things apply in terms of risk and fraud and errors. These things are real anywhere you go. Trust me on that one. Even in your own household. You have a dictator in your home? That's spooky.
That remind me of a financial institution that I was working at before, where some members were coming in and they were saying that they gave in money, but the staff members were telling them that the system was down, so they had to record the transaction using the manual receipt books.
Yes,
So when the staff came in, they were saying, why isn't the money on my account or whatever. So
yeah,
when the management went to go and look at the receipt book, the whole page, like the counterfoil, was missing out of the receipt book.
yes.
So when I saw that inside this thing here, I was like, this is spot on, and that actually happened at the place I was working.
And it happens more frequently than you can ever imagine. And thank you for bringing that to the attention of your colleagues, because sometimes folks might actually think it's just an academic exercise. It is not just an academic exercise. It is a very real thing. See that crap? The system is down, and they know very well the system wasn't down. The system may even have been down, and the receipt book was in use because the system was down. Only problem is you cannot find the counterfoils. They've been taken out. So you can't verify what the hell happened. Wow. All right, keep going, Gretchen.
Number 3, unusual pressures within the entity. For example, industry is doing well, but the company's performance is poor. Heavy dependence on a single line of product, inadequate working capital, and the need to show more profit to support the market prices of shares.
In other words, the more pressure management is under to do more and more and more, despite the environment, the more likely they are to commit fraud, to lie their way through to make things look better than they are, so they don't lose their jobs, so they don't look bad in the face of the shareholders and so on. We're not supposed to do it. We understand the pressure, but the truth of the matter is, despite all that, you're supposed to still do the right thing. And auditors are, whether you believe it or not, if they're doing their jobs properly, they consider all of these issues. Okay? Keep going.
Number 4, unusual transactions. For example, transactions with related parties, excessive payments for certain services to lawyers and consultants.
Pick a pen. So when that auditor comes in and they see law firm, Hog Dog and Co., $350,000. Man, that is a red flag. 150,000, 75,000. They're red flags for any good auditor. When you see that stuff, they have to investigate to see if that's a legitimate transaction, because it might not be. Because they might discover that the lawyers or the law firm is padding their invoice, putting more on it than the service actually is. The company pays that amount to the lawyer, and then somebody higher up in the firm goes to the lawyer to get their share of the money. Same thing for consultants. Spooky happens every day. Every day it's called fraud. And yeah, fraud. And most times it's not committed by regular employees. See, like you and I. It's committed by top management people in positions of responsibility, board level, senior management level, the pulpit, the doggone elders of the church, whatever, the Pope and company, whatever it is. They're the ones who are up to no good oftentimes when it comes to these major frauds. Imagine that. The Vatican has crooked people in it. Did you know that? Did you guys know the Vatican has crooked people in it?
Yes, 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 we did. I actually some of the most crooked people in the Vatican.
Yes, they thief in money all the time.
The
The,
Vatican,
the Vatican.
the church people, or
They-
religious people.
In Jesus' name, I don't know if it's Jesus' name. Yes,
Oh, wow.
every day there's fraud going on. when they're not defrauding the doggone Vatican resources that are contributed by the people to do the work of the church, they are doggone molesting children, whoever they are.
Wow.
Bastards. Did I say bastards? I said unapologetically. I don't care. Quote me. Doggone it. Imagine that. The church. Because people trust the church just like we trust auditors, don't we?
Yes.
And so whenever they do things wrong and mess things up, it's a mess of major proportions. How the hell they could be molesting little children by the thousands for centuries? Imagine that. This isn't something they started in 1973 when we became independent. These guys were doing this around the world for centuries. My. Women going in for counseling. And before you know it, it goes from counseling. Okay. I don't know if there's anything fraudulent. I suppose there's something fraudulent about that as well. All right, keep going, Gretchen. Since you're still in the fraud area.
Number 5, problems obtaining sufficient and appropriate audit evidence. For example, inadequate documentation, significant differences between the figures in account records, and confirmations received from third parties.
Yes. So auditors come in, internal or external. They ask for documents to verify transactions. And somebody comes back and says, we can't find them. Or we only have some. Can you use that? Some nonsense. Does an auditor want to hear that? No. Auditors start looking at numbers, and the numbers, the differences are not like 10, 20, 30, $100, $300. It's in the thousands of dollars. And depending on the company, millions in differences. Auditors send something out to the bank to verify a bank loan balance. The bank sends a confirmation back, says the loan balance is $3,500,000. The company's records, though, on the other hand, is showing 1 million as outstanding in loans because they're trying to cover it up, trying to give the impression that they don't have that much outstanding in loans. So they put the company records at 1 million, but when the bank confirmation comes in with the bank record, it's 3.5 million. Or the customer sends a note back and says, this statement you sent me is not correct. I've already paid $3,000 on this account. It shouldn't be 7,000, it should be 4,000. Now the auditor is prompted to investigate, finds out that somebody collected the money, and what's the refrain for our song? They collected the money and
Put it in the pocket.
absolutely. Okay. Whenever you guys write a song, please give me some of the royalties. The name of the song is Put It in Your Pocket. Okay. That's usually the result of fraudulent activity. All right. Okay, Gretchen, thank you very much for introducing us to all that crazy stuff on fraud. And so with all that fraud going on potentially in any organization of any kind, profitable or non-profitable, charitable or otherwise, auditors have a huge responsibility in terms of how they detect and how they manage fraud. Wow. So let's look at that for a moment. We are told that the primary objective, see, back to that again, is to express an opinion on the financial statements. Notice, while conducting an audit, the auditor has to keep in mind that there might be real serious misstatements in the financial records resulting from fraud or error. So that means that as the auditor conducts its audit, they have to bear in mind that those financial records could maintain frauds and errors, and not little itsy bitsy ones, material ones, in the thousands or millions or more, depending on the size of the firm. Okay? That's something that they have to always keep in the back of their minds. Secondly, Auditors have an auditing standard that they follow. It's called GAAP or P, Generally Accepted Auditing Principles or Standards, and they provide auditors with guidelines on how to conduct their audits of financial statements to try to make sure that those statements are free of misstatements, whether by fraud or by error. We now know the difference between the two, so there's no confusion about what we're talking about. Okay. Notice I have something in bold and underlined. I notice what comes before. The fact that an audit is carried out may act as a deterrent. Anybody knows what a deterrent means? Anybody has a Google thing on their phone? Google deterrent.
Like something that would stray you away from it.
Yeah, that may help you to stop doing it or move you away from it, to get you to stop a deterrent. Like for example, if you're going to go to prison for stealing bread, the deterrent is you're going to go to prison so you don't steal the bread, hopefully. Okay?
Right.
Yeah. So while the audit is carried out may act as a deterrent to some extent, notice what is underlined. The auditor is not and cannot be held responsible for the prevention of fraud and error. Anybody knows why?
Because um
You need to do the book, examine the books.
also because his view is opinionated.
It's fair, free and fair.
Well, he's coming in to give an opinion, but certainly when those frauds and error were being committed, was the auditor there?
No.
No, so
No, so he can't control that. It's just that the guy who shot those innocent little babies the other day. The police doesn't know when somebody's going to decide to start shooting little children.
Right.
The same problem. So the auditor cannot be held responsible. So now the problem is, oftentimes when auditors go in and they do not detect a fraud and it becomes public or is exposed, then the auditor ends up taking the what? Blame.
Uh-huh.
Here's what companies say. Aren't you the auditor? Shouldn't you have picked it up? And the answer to that is maybe, maybe not. The auditor is only an auditor, being guided by auditing principles and experience. They are not God. They cannot check every single transaction, and so therefore they could easily miss a fraud or error, whether it's material or not. That's just the way it is. Just like a surgeon going in to cut you open. They could miss a turn on that cut. They could pick up an instrument that was not properly sterilized. See my point, folks? They could accidentally hit another vein or aorta that they shouldn't hit while they were working on something else for any number of reasons. So the fact that the auditor has conducted an audit and given an opinion doesn't mean that they can guarantee you that they are in a position to prevent fraud and error. They're not. Should they be looking for it in their audit? Sure. If they see it, should they make a note to management? Of course. But they cannot be held directly responsible. Okay? So if that is the, what then is the auditor's opinion based on? Now, despite all of that, some companies still blame the auditors when things go wrong, fraudulently and otherwise. We just paid you all that money to do the audit, and now we discover that somebody committed fraud after you left. How come you didn't discover it? We don't want you back next year. When in fact, it really wasn't the auditor's responsibility, nor can the auditor give any guarantee. That's like asking the police to anticipate when somebody's going to pull the trigger. They can't. Same principle. Okay? So if that's the case, then what is the auditor's opinion based on? Well, we are told that it's based on the auditor obtaining reasonable evidence and assurance. Reasonable, not totally. They go in with a plan, they review the various accounts, their balances, their totals, the transactions. They take samples, they look at those samples, they look at higher transaction amounts, etc., as much as possible in order to get reasonable assurance that those financial statements are in order. But they cannot guarantee any misstatement of fraud or error. They cannot guarantee that will be detected. Okay? So if you ever have that conversation, perhaps you'll have a little more understanding, at least from the auditor's perspective, because sometimes organizations understand it, and depending on the organization, sometimes they don't. And sometimes they do, they just don't want to accept it because they need somebody to, who knows what the word is. They need somebody to
Blame.
name, yes, remember?
Yeah.
All right. Now, notice we are told right in that same paragraph, page 10, the subsequent discovery of any material misstatement of the financial statement resulting from fraud or error does not and of itself indicate any number of things. So yes, because the auditor didn't pick it up, it doesn't mean that the auditor didn't take all steps in A to obtain reasonable assurance. Oftentimes they have done that. They just didn't pick it up because they can't check 100% of everything. And some frauds are well hidden, especially if people have colluded to do it. So not only can you not pick it up, it's almost impossible. Okay? It doesn't mean that they did not plan their audit and perform it properly and carried out good judgment. Doesn't mean that they didn't exercise professional competence and due care. Doesn't mean that they failed to comply with generally accepted auditing principles. Doesn't mean any of that. Just means that they missed it. Okay? Just like somebody driving, following the speed limit, doing everything right, then a drunken driver comes speeding, run the light, runs into them and kills everybody in the car. So the people in the car are like the auditors. They've taken care to do everything that they were supposed to do. But if somebody's committed fraud intentionally and hidden it through collusion or otherwise, with the help even of top management, then because of that, doesn't mean that the auditor has not done its job in A, B, C, and D. More often than not, if they're doing their jobs properly, they've done all those things. They did obtain reasonable assurance by checking as much as possible. They did plan the audit and exercise good judgment. They did exercise good competence and due care, and they did follow generally accepted auditing standards. But in all that, just like the people in the car, they can miss it, and that miss is referred to as the drunk driver who runs into them. Okay? For sure. All right. So, thank you, Gretchen. Let's see who can help out with. Okay, Rosalie, did you read last week?
Yes, I did, but I can read.
Don't mind reading again?
Pardon me?
Don't mind reading again?
No, I don't mind.
Okay, then let's pick up at page 11 at the top. This is particularly the case.
Okay. This is particularly the case for certain kinds of intentional misstatements, since auditing procedures may be ineffective for detecting an intentional misstatement that is concealed through collusion between or among one or more individuals in management, those charged with governance, employees, or third parties, or activities involving falsified documentation. Whether the auditor has performed an audit in accordance with auditing standards is determined by the adequacy of the audit procedures performed in the circumstances and the suitability of the auditor's report based on the result of these procedures.
In other
In
words, the auditor has a responsibility to do it right. And despite all of that, if they go through all of those steps and do everything they're supposed to do, and we have crap happening like in the paragraph above by senior management and all that stuff, then despite all the great work that the auditor has done, a lot of things or certain things, frauds, etc., might go undetected, and some of which will come back and create havoc for the company later on, for which, of course, the auditor more than likely to be blamed, depending on the firm involved. Okay, all right. Go
In planning and performing his examination, the auditor should take into consideration the risk of material misstatements of the financial information caused by fraud or error. He should inquire with the management as to any fraud or significant errors which have occurred in the reporting period and modify his audit procedures if necessary. If circumstances indicate the possible existence of fraud and error, the auditor should consider the potential effects of the suspected fraud and error on the financial information. If he is unable to obtain evidence to confirm, he should consider the relevant laws and regulations before expressing his opinion. The auditor also has the responsibility to communicate the misstatement to the appropriate level of management on a timely basis and consider the need to report it then change with governance. He may also obtain legal advice before reporting on the financial information or before withdrawing from the engagement. The auditor should satisfy himself that the effect of fraud is properly reflected in the financial information or the error is corrected in case the modified procedures performed by the auditor confirm the existence of the fraud.
You stick a pin for 1 second, Rosalie. So now you
Mhm.
see, earlier we said the auditor cannot be held responsible for detecting fraud and error as a result of conducting the audit. Then we get down in the mire a little bit and we say, okay, if the auditor does suspect fraud, what indeed should he do? Okay. And
Right.
even for that, we are told in the previous paragraph, he should inquire with the management as to any what? Significant frauds or errors which might have occurred. So now the auditor is trying to get some assurance from the management who is there from day to day, meaning the management and staff, with regards to the possibility of errors and frauds in order to minimize what the responsibility might be that might come to bear on the auditor if frauds and errors are not detected. So he starts off by saying to management, are you aware? And sometimes management, they are aware because they're the ones who committed the fraud, but yet they'd say, no, Mr. Auditor, we are absolutely not aware of any fraudulent issues within the company, when many of them very well know that they are the perpetrators of the major frauds in some instances. Okay? So
Mhm.
that's the first issue. And the second thing the auditors consider after asking management about fraud issues and errors is what is the effect of any fraud or error on the financial statement potentially? And to find out if he can find any errors to support any suspicions he might have.
Mhm.
And to consult the law if necessary. Notice how far, depending on the nature of the problem, the auditor may have to consider going in order to see whether or not there's any justification for fraud and errors and what impact it will have on the financial records. Because remember, some frauds and errors are so small in amount, the auditor might say, no big deal, just write it off or make the corrections. Okay? But some of them, of course, can be involved in the millions of dollars, and so therefore there's greater potential loss for the company. And who's in the middle of all this mess? The auditor. Okay? Now,
Mhm.
if the auditor discovers a misstatement or an error or fraud, the auditor's job is not to cover it up, not to hide it, not to ignore it. They have to go to the management quickly, report it, let them know what is necessary, what's going on. If the auditor has to get legal advice before reporting it, for whatever reason, in order to protect its engagement, then they should do that. The auditor has to satisfy himself what the effect of the fraud is likely to be on the financial statements and whatever they might be, make provisions through management to correct the errors and the fraud if it exists. And if there are any culprits, to make sure that the culprits are identified and dealt with.
Mm-hmm.
Okay? That is about the best that the auditor can do with regards to his or her work with that firm's audit. Okay? They're not God, they're not perfect, they cannot guarantee certain things. Certainly, they cannot guarantee the absence of frauds and errors, but they could guarantee that if they discover it, they'll report it, and if it can be fixed, they'll help you fix it if you need their help. They could certainly guarantee you that as an organization. And that's all they should guarantee. And then they should actually do it when the time comes. Do not let top management persuade them to do otherwise, to hide it, to cover it up, to not report it. Okay? Especially if it's a matter that needs to be reported to who? The shareholders of the company. Some board members try to get auditors to hide serious fraud and errors and issues from even the shareholders who own the firm so that they don't have to give an account for their actions. Okay? All right, welcome to the world of auditing. If you thought it was just a little exercise and blah, 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 I think you're beginning to get the idea that it's not. It is really serious business. It is critical to the firm. It is critical to individuals who work for the firm. It is important to have some knowledge of it so that as you go about your day-to-day work, you understand what's really going on potentially in the firm where you work, such that you're no longer able to feign ignorance, or you are now much more informed than you were last week or 6 weeks ago, and therefore you should be better at whatever you do in whatever environment you work in. And if you expect it to be even better after 3 weeks of this crazy stuff, imagine the kind of information you're going to have in 10 weeks, okay, to your benefit. That's the point, no matter what capacity you work in. All right, keep going, Rosalind.
Okay. The auditor should also consider the implications of the frauds and errors and frame his report appropriately. In case of a significant fraud, the same should be disclosed in the financial statement. If adequate disclosure is not made, there should be a suitable disclosure in his audit report.
Indeed. And many firms, when there is a major fraud,
Mhm.
board and senior management oftentimes try to make, bribe, intimidate, or whatever the auditor to not disclose it in the financial statements. That is a no. That is a serious violation of the audit ethics. And if any auditor or audit firm is found doing that, they're going to be in serious trouble. They may lose their accounting license. They could be sued. Any number of things can happen. And depending on what you're involved in, you might even end up in prison as an auditor for allowing
Mhm.
senior management to get you involved in something potentially even criminal. Imagine that. You go in to audit the books, say what the hell you see, and get out. And all of a sudden, because of all kinds of blah, 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 you're in the middle of a big time, stinky firm mess because you got tied up with senior management agenda, which oftentimes is not good, unfortunately, because they're the ones responsible for the firm. Okay? All right, keep going.
Mhm. Basic principles of audit. Auditing and assurance standards describes the basic principles which govern the auditor's professional responsibilities and which should be complied with whenever an audit is carried out. These are integrity, objectivity, and independence. The auditor should be straightforward, honest, and sincere in his approach to his professional work. He must be fair and must not allow prejudice or bias to override his objectivity. He should maintain an impartial attitude and appear to be free of any interest which might be in conflict with his audit duties and responsibilities, or which might be incompatible with his integrity and objectivity.
Now, interestingly enough, isn't most of this something that should apply to all of us in our work, folks?
Yes.
Yes. So in a way, all of us are supposed to be kind of what? Self-auditors, aren't we?
Yes, we are.
Self-auditors carrying out our own little audits of ourselves and our environments by adhering to the same rules that we expect from the auditors that come in. How interesting is that? All of us, just
Yes.
like the auditor, is expected to be have integrity or honesty, be objective, and be independent and not influenced by people around us to get us to collude and do other stinky stuff. How's
Mhm.
that? All right, keep going.
Confidentiality. The auditor should respect the confidentiality of information acquired in the course of his work and should not disclose any such information to a third party without specific authority or unless there is a legal or professional duty to disclose. It has been said that an auditor should keep his ears and eyes open but his mouth shut.
Doesn't that apply to us as well as employees?
Yes, yes, yes,
Absolutely, especially those of us who work in financial institution with
right,
personal information. Yes, and those
definitely.
in the hospital with people's personal health licking records.
Uh-huh. Can I
The same
can
thing.
I say this? Can I say this to you? Working in a financial institution, I work at the law enforcement credit union, but I also
Yeah,
have a second job, and a lot of the at a bar, and so a lot of the security officers are law enforcement officers who come inside the credit union, and so
yeah.
they have a certain demeanor in the credit union, and I know all of their financial information. But then in the bar, it's like I have to pretend like I don't know that. You don't understand what I'm saying?
You bloody well better believe you have to. You have a duty, okay? For sure. In
Mhm.
fact, in your case, you have a double confidentiality issue because remember, just like in the movies, bartenders are supposed to be able to keep what?
What?
Secret. There's people who come to the bar always talk to the bartender about their what? Problem.
Um, yeah.
Yeah. Like my wife is really getting on my nerve. I don't know, maybe I should leave her. Or that husband of mine, I'm tired of him. Should I poison him, Mr. Bartender, or whatever? People tell you personal stuff, and even as a bartender, you have to maintain a certain level of confidentiality. Not to mention in your main job in financial services, eyes and ears open and mouth shut.
Mm-hmm.
Because none of us who are in possession of people's personal data should be talking about it, not even to our spouses, not to our mommy. And that's my mommy. She ain't gonna tell no one. Doesn't matter. I don't care if you have your mommy squared. It's not your mom's business. Now, if you want to talk your other personal stuff to your mom, some of which you shouldn't talk either, like what's going on in your home between you and your husband. See? Not your mom's business unless your husband is abusing you, then that's more than your mom's business. That's flicking police business. See my point? But other
Mm-hmm.
than same kind of principle, same kind of principle, confidentiality. Thank you very much for bringing that example because it now gives us like a real life perspective on these issues. Okay, keep going.
Mm-hmm. Skill and competence. The audit should be performed and the report prepared with due professional care by persons who have adequate training, experience, and competence. This can be acquired through a combination of general education, technical knowledge obtained through study and formal courses under proper supervision.
Mhm.
Work performed by others. When the auditor delegates work to assistants or uses work performed by other auditors or experts, he will continue to be responsible for forming and expressing his opinion on the financial information. At the time, he is entitled to rely on work performed by others, provided he exercises adequate skill and care and is not aware of any reason to believe that he should not have relied. The auditor should carefully direct, supervise, and review work delegated to assistants. He should obtain reasonable assurance that work performed by other auditors or experts is adequate for this purpose.
Notice, even though other professionals and staff members and others who are supposed to know their jobs are supposed to know their jobs, and most of them do, and do it well, the auditor still has to be careful that when he delegates work to any professional, assistant, or otherwise, that he should still be checking with reasonable care to see if he can rely on that information. Because sometimes, because a professional gives a report, that doesn't mean you should actually do it. Because sometimes certain professionals say some strange things, true or false.
Mhm.
Okay?
True.
Example of how serious it is. Several decades ago, when my baby was born, my oldest son, little Sam, he had bow legs. You know what bow legs are?
Yes,
Yeah,
Ben Lake.
yeah, he had bow legs when he started to walk. So he's like 18 months, like walking, little bow legs. So I went to take him to, well, two things little Sam had. He had bow legs, and he had these little eyes that looked like they were kind of closed down, like dead eyes. And so at 2 years old, I gotta have his eyes checked just to make sure that basic things are working. So here's what the doctor says at the time. The doctor, see, he's a professional, right? Doesn't mean he's not a good doctor. But here's what he says in this case. Oh, I see Sam has the legs a little bow. We could fix that up. We could put them in braces, or we could break them and let them grow evenly. Did you hear what I just said? He said we could break them and let them grow evenly. They've done that a few times. What's wrong with that advice?
Well, it's only one opinion.
That's the first problem. But the other problem is, who the hell breaks the legs of little child who's not even developed yet? You have to let the child develop to see if it's going to persist. 'Cause here's what I mean. I'm like,
Mhm.
legs, and he's only 2. What kind of hell talk is that? And then you guys break it the wrong way, and then what? He's crippled and walking funny. What are you going to tell me then? So I'm like, are you kidding me? He's only 2. Thank you very much. And I'm gonna just let him grow. By the time little Sam was 5, not only was he not bow leg, he was almost knock kneed.
Oh, wow. What a
My
reverse.
legs straightened right up. Get my
Wow.
point, folks? So what I'm
Yep.
saying, I'm not saying that sometimes that professionals are not correct in their opinions, but sometimes they're wrong,
Right.
or their opinions don't always have the proper basis. And so the auditor, that the point I'm making is the auditor has to consider all these issues when he's relying on work performed by others. He's not saying that they're not competent. He just has to be careful in his assessment of the work and what he relies on, what he doesn't. Imagine that. With all the other problems the auditor has, he has to now figure out which which information is this correct? Is this based on a proper premise? Do I have the right professional? Somebody told me this guy drinks. See my point? And should I rely on history? See, all these things are real. And all of these things the auditor has to consider. All right,
Mhm.
keep going.
Documentation. The auditor should document matters which are important in providing evidence that the audit was carried out in accordance with the basic principles.
Okay, so now the internal auditor in our group, one of the things you have to keep in mind with your work is number 5. Whatever you do in your audit, you have to properly document it. What you did, what the results were, what you discovered, and how it was resolved. Everything has to be documented. If it's not documented, you could be accused of not actually even doing it. not to mention not being able to go back and actually make an assessment of what you did, and to provide proof in your report of your opinion and your results. The documentation, like compliance, is crucial. In compliance, we say, if you didn't document it, it didn't happen. Doesn't matter if it did. If you didn't write it down, it didn't happen. Okay? Keep going.
Planning. The auditor should plan his work to enable him to conduct an effective audit in an efficient and timely manner. Plans should be based on knowledge of the client's business. They should be further developed and revised, if required, during the audit. Audit evidence. The auditor should obtain sufficient appropriate audit evidence through the performance of compliance and substantive test procedures. It will enable him to draw reasonable conclusions on which he has to base his opinions on the financial information.
And later on, we'll see what we mean by substantive testing. It is not
Okay.
as unbelievable and not so understanding as it might seem. It's a nice big old word, substantive test procedures, but we'll see later on what that means. Okay, keep going.
Accounting system and internal controls. The auditor should gain an understanding of the accounting system and related internal controls. He should study and evaluate the operation of the internal controls upon which he wishes to rely in determining the nature, timing, and extent of other audit procedures. Audit conclusions and reporting. The auditor should review and assess the conclusions drawn from the audit evidence obtained and from his knowledge of the business of the entity as the basis for the expression of his opinion on the financial information. The audit report should contain a written expression of the auditor's opinion of the financial information. It should also comply with the legal requirements in case a qualified opinion, adverse opinion, or disclaimer of opinion is given.
Thank you very much, Rosalie. And since we're just getting around to the end of module 2, don't panic. Those things like qualified opinion, adverse, and disclaimers, we're going to talk about those a little bit later in terms of audit reports. But for now, you should know that if a company is successful in its audit, it should be given an unqualified opinion. Unqualified. Unqualified.
Oh,
means-
my manager told us that we got that, and I was so sad.
You were so what? Happy?
I know I was sad because I thought that was bad.
I know. It's interesting. Thank you so much for saying that. A lot of people still think it's bad. Okay? Because we tend to use unqualified like for people you're not qualified. You're unqualified for this job. You're unqualified to be a parent. That doesn't mean the same in auditing. When you get an unqualified opinion in auditing, it means that you have passed the test and you have completed a successful audit. If you get a qualified opinion, it means that the auditors have conducted the audit, but they have some questions and concerns and issues for you to deal with. And so what do they say? We have completed the audit, but it's a qualified audit opinion, meaning that we have to indicate some problems that we discovered. Okay? When we get down to adverse opinion, that's even worse than a qualified opinion. That means that the auditor was not able to successfully conduct the audit because files are missing and people were lying and numbers were wrong and they couldn't substantiate anything important that they sought in their audit. And so they end up giving adverse opinion, which is a very negative opinion for an auditor to give. You do not want that. And a disclaimer speaks for itself. A disclaimer is far worse even than an adverse opinion, and you shall see later on what are the components of an audit disclaimer. But for now, let's be happy. If you get an unqualified audit, you have had a successful audit. Okay? So, in terms of exam question for something like all of this, theoretically, because we've gone through it, you basically have an idea what each one of these are. You may not be able to reproduce it exactly the way it is, and you're not expected to reproduce it exactly the way it is. But you are expected to be able to comment briefly on what these principles are. And you ought to be able to list a couple of the principles. Suppose I were to say, list and describe 3 or 4 audit principles that we discussed. Then you say one, integrity about telling that and say what it is. Confidentiality, remember that off the top of your head. Don't tell people people's business. Skill and competence, the auditor must be qualified. See, it's not hard. Work done by others, the auditor needs to check and make sure it's okay. Document everything. You can pick any number of them. I'm not going to ask you to list all of them. I could, but I'm not going to do that. I'm going to ask you to list 3 or 4 of them. And for most of you, if not all of you, that should be a walk in the park. Okay? Just saying so you can start focusing on what's key, what's key, what's key. But that doesn't mean you don't read. You have to read everything because reading is core. And then that sets the foundation for all the stuff you're going to do after in preparation. All right, so we're going to stop there tonight. You guys have been totally fantastic. Please, if you haven't read this module, we've done most of it for you. Go ahead and read the rest of the next 3 or 4 pages and then go right into module 3. And if you're having a really great week and weekend, then you can start reading module 4. Because when we come next week, we're going to finish up module 2 real quick. And then we're going to jump right into 3 and start tearing it apart. And then depending on how much time that takes us, we might still have a little time to jump into module 4. Any questions?
So basically, this paper contains what, 6 modules?
Which paper?
I mean, this document that you sent us online. I printed it off, so I don't read it online. I read it like a hard copy, so it has no numbers and stuff. So basically, the last module that I see on the one that I printed, it ends with this: what essentials of a good internal check system. Is that the last thing?
It sounds that way to me.
So that's this 6 modules or this 12?
Well, we are going to be doing altogether, we should be doing 10 modules.
Oh, so the exam is going to be inclusive. The midterm exam is going to be inclusive of how many modules? 5?
First 5 modules.
Okay, so I'm wondering if this 5 here and this. So this document you sent us, this have the 10 or this have 5?
You want to know what constitutes 5?
Yes, please.
Okay, let me just. Usually the headings will tell you, but just make sure that you're on the right track. Okay, module 1 would be introduction and overview, right? That's what we did last week. Module 2 will be what we did today. Principles, types, etc. Yes? Module 3 will be audit planning, which we'll do next week. Audit module 4 will be audit techniques, which we might start next week.
Okay, audit techniques.
And then module 5 will be internal controls, which will be the final module before the midterm.
Okay.
Okay.
All right. Yes, sir.
So that's your focus for the first part of the semester. And once you have exhausted the material in those first 5 modules, then you'll be ready for midterm, one way or the other. So do not be afraid to read ahead, make notes ahead, try to remember as much as you can ahead. That's fine. The more you work it, it's like anything else. You want to be really good at it and be competent at it and be comfortable with it. You have to do it over and over and over. Okay? And
Okay.
no magic to it. Kobe and Jordan were great because while everybody was sleeping, they were shooting hoops by the thousands. See? They didn't become great because they were some kind of magicians and they just got up with all that talent. Didn't work that way. They had to put in the work. Yeah. And the more work you put in, the easier it gets and the more successful you'll be. And audit class session is no different. Just put in the time and the results will will take care of themselves. How do I know that? I've written 1,000 examinations in my lifetime a long time ago. I know what I had to do when I was doing my associate's degree and then my undergraduate degree, my graduate degree, and my professional qualifications, and my Series 7 examination, all that crazy stuff I did. I know, been there, done that with all this crappy stuff. Not crappy, you know what I mean? Okay? But really, what I'm telling you is exactly what I have to do. I have to make a serious commitment. And you make it for the time you have to make it. And then after 12 weeks, you're done. You can go on the beach, put on your bikini, have a glass of wine, and relax. Because then you'll be successful with your results. I tell students that all the time. Knock yourself out until the semester is over, and the results will speak for themselves, one way or the other. All right. So good luck with all that crazy stuff. You guys have my contacts. If you get stuck somewhere and you need something to be clarified, send me a text, send me an email. I'll be happy to respond. Until then, go ahead and finish up the remaining 2 or 3 pages. Go into module 3, start reading and getting into that because we're going to jump right into that next week, and then we go forward. Okay. You already know what you're responsible for. So those of you who feel like really, really froggy, you can go even further. Don't worry if you don't understand everything you read. That's not expected. Just go ahead if you have extra time and you feel really, really ready to go. Read further on if you want to, and then when we get to the class sessions, we can sort out all the cobwebs when necessary. Okay.
Okay.
All right. Good luck. Be safe. I'll see you guys next week, Thursday. Remember, COVID is still around. Don't take anything for
Granted.
absolutely. All right. And remember, if you're not studying my audit stuff, you should feel guilty.
All right.
Uh-huh.
All right. Take care.
Yes, sir.
Good night.
All right.
Good
Bye-bye.
night.
All this is just for 45.